Good afternoon, everyone. Very good. As someone rightly said, a tax loophole is something that benefits the other guy. If it is beneficial to you, it is called a tax planning. Today, we all are gathered here to understand the nitty-gritties of the corporate tax. And before we move on behalf of the managing committee, I would like to congratulate each one of you for your active participation in all our events, and thanks to our past chairman, C.A. Sundar Nurani, and current chairman, C. Anurag Chaturvedi, for winning the Best Chapter Award 10th time in a row on your behalf. That's the spirit. I was about to ask applause. You applauded. So photo we will take later on when Nurani ji will be here. So let's start the technical thing. As we know, the UAE, as a member of the OECD Inclusive Framework, has introduced the federal corporate tax regime as a stepping stone to the execution of its commitment to the global minimum effective tax rate concept proposed by OECD Base Erosion and Profit Shifting Project under Pillar 2. By introducing CT, the UAE aims to further its objective of accelerating its development and transformation with a competitive CT regime that adheres to international accounting standards. Together, the UAE's extensive network of double tax treaties, which will cement the UAE's position as a leading jurisdiction for business and investment. CT regime will build on international best practices as opposed to introducing new concepts. In order to ensure the seamless integration and cooperation of the regime with existing international frameworks. Today we have with us our learned speakers to share their expert views and insight on key aspects of the corporate tax. Speakers will edify all of us with a couple of crucial perceptions and will take us through with its implication. Before I go further into substance, I would like to warmly welcome today's speaker, C.A. Nilesh Ashar, Mr. Kapil Bhatnagar, C.A. Joseph Philip, C.A. Neetu Jose, C.A. Pratim Sen Gupta, C.A. Manu, C.A. Komal God, Chapter Chairman C.A. Anurag Chaturvedi, past Chairman of the Chapter, fellow members, friends, and seniors in the profession, sponsors, and my colleagues in the Managing Committee and distinguished guests, a very warm good afternoon to all of you. So this is formal good afternoon. I, Manoj Agrawal, Secretary of the Chapter, welcome each one of you to today's session T3, Tax Think Tank. I express my sincere gratitude to today's speaker for accepting our invitation. I also thank each one of you for your active participation. Let us have a big round of applause for the speaker and all of us. While our speakers will take us through with many exciting areas, it is now time to pay respect to our nation and profession. May I now request everyone to please rise for the UAE and Indian national anthems and the ICAI motto.
अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल बंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कापुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैता 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 एतद्वैता.
Thank you very much. Please take your seat. We have ample of seats in the front rows, so you can come forward. Now, another good news is today was the last day of our president of ICAI India's Dr. Debashish Mitra ji. So from today onwards, CA Aniket Sunil Talati ji is become president and CA Ranjit Agrawal ji is our vice president of ICAI India. A big round of applause for both. देखो ताली बजाते रहा करो, ठीक है? It is always essential to recognize the ones who always support us. Let us recognize our sponsors, principal sponsors, Pen Emirates Home Furnishing, AGMC, Tele, Lulu, and IFCO. Platinum sponsors, Emirates Chartered Accountant Group, WMS, CloudSook, Vested Finance, Nullsoft, UHY James, and Jedox. FMCG partner, Aktia, media partner, College Times, institutional partner, Delhi Private School, banking partner, Bank of Baroda, and magazine partner, Finance World. Let us appreciate our sponsor for their support with a big round of applause. Thank you. Ladies and gentlemen, I am sure that today we will get advantage of valuable experience of our speakers on UAE corporate tax. Our first topic is importance of group structure in tax planning. Why businesses should explore reorganizing their existing group structure? Any idea? Just to create some holding companies, subsidiary companies like that. Because it will increase the administrative, operational, and economic efficiencies, de-risk or strengthen the group, and most importantly, tax planning can be executed, which resulting into tax liabilities. Group reorganization doesn't mean only to add or remove subsidiaries or creating few more layers in the holding structure. For the purpose of tax efficiency, group structuring includes transfer of properties or assets, rearranging cash flows, consolidating various subsidiaries, or creating companies, new subsidiaries, new branches as well. And to elaborate more on these aspects, today we have with us CA Nilesh Ashar, Senior Managing Director, FTI Consulting. And to introduce him, I would like to invite our Vice Chairman, CA Harikishan Rakawat, at the stage.
What a great theatre. One lady actress and 6 gents speakers, actors. And what a great audience today in the hall. And that too on Sunday, this premiere show from 3 to 6. Great. Keep it up, guys, with the love and affection with the corporate tax. Good afternoon, ladies and gentlemen. How many of you have attended a corporate tax awareness session conducted by the FTA? Okay, so I actually took away 2 points. One is like all the SSEs, all the companies, they have to file their return of income, whether their income is zero or they are into loss or they are having more than 375,000, doesn't matter. Whether they are in the free zone or mainland, doesn't matter. Everyone has to file their return of income. So it's a good news for all of us. And the second one, like in VAT, there is a deregister button. You can always deregister. But in corporate tax, they mention that there is no deregister button. So I was just thinking, if the company is going to liquidate or close, then how to, take the step. That's what I was thinking. And now, you guys are aware that death and taxes can't be postponed. I know the doctor can reduce the pain if you have more pain, and as a chartered accountant, tax can't be postponed, but yes, as a chartered accountant, we can always help in tax planning and tax optimization and reduce the tax. That's what we have to do. And today I am privileged and honored to introduce our first speaker, CA Nilesh Asar, Senior Managing Director from FTI Consulting. Mr. Asar is an international tax and corporate tax specialist with more than 25 years experience in complete tax engagements in sectors such as real estate, financial services, private equity, oil and gas, retail and family offices across the Middle East, India and UK. He is based in Dubai since 2012, following stints in India and London. Mr. Asar brings a range of tax experience to FTI consulting clients, including advisory services focused on corporate and international tax matters, cross-border tax restructuring, M&A tax, economic substance, tax governance, transfer pricing, and VAT. Prior to joining FTI Consulting, Mr. Asar spent his time with multiple Big Four firms, during which he set up the India tax desk in London and led the UAE international tax practice for a boutique firm. Mr. Asar is a regular speaker at seminar, conferences, client workshops, and various industry forums. Could you please put your hands together to welcome CA Nilesh Asar.
Thank you, Sai. Thank you. Good afternoon, everyone. I think this reminds me, other than the first show of Pathan, this is, this has been a full house. Yeah, so thank you all for turning up at this session. So when I was asked to give a speech on impact of group structure in tax planning, and I saw the rest of the agenda, each speaker had a very specific topic. And I thought Anurag is pulling a fast one on me saying, talk about anything under group structure or talk about nothing. So I've changed the title, if you see, I've changed the title slightly to the group structure review under corporate tax. Now, and the reason for that is, for any groups operating in the UAE, any companies that are based in the UAE, looking at your structure in advance of corporate tax being introduced is extremely important. Tax planning, tax compliance, preparing for corporate taxes, these are all part of reviewing your operations, reviewing your entities, reviewing your group structure. So I've taken the liberty to change the title slightly. I hope you're fine with that. Now, before I get started, the law came out on the 9th of December. I presume all of you have read the law. Yeah? Anyone here that hasn't read the law? So what we're going to start is, let's try and do a recap, and let's see how much of the corporate tax law each of us can remember. So if I look at the UAE corporate tax in numbers, and this is where I need some participation from the audience, if that would be helpful. What's 9%? Tax rate. Excellent. 0%? Tax rate. Tax rate on qualifying free zone person. That's the qualifying income tax rate. Excellent. You're doing my job. It's excellent. Also, it's the tax rate if you're less than 375,000 dirhams of income, and it's also the withholding tax rate under the UAE tax law. The UAE tax law talks about withholding tax applying on UAE sourced income, which has a very wide definition, and the rate specified under the tax law is 0%, which obviously is easier for the Ministry of Finance to change once the rate is in the legislation. 15%? Global minimum tax rate. Excellent, Naveenji. Likely Pillar 2 rate. Now, this is not specified in the law, but we all know that the global minimum tax rate is 15%, and we know that the rate is likely to come into play once UAE incorporates the Pillar 2 regime. Tax group. Oh, excellent. So 95% is the 95% shareholding control criteria to form a corporate tax group in the UAE. Tax loss transfers, anything else? And a qualifying group. What's the relevance of a qualifying group? Yeah. It's a qualifying group transfer condition, 75% direct or indirect ownership, and also for transfer of losses. So Article 26, 27 is on business restructure, qualifying group transfers. 50%? Limitation of loss. Limitation of loss carry forward is 50%? Is your related party criteria 50% or more? And my colleague here, Kapil, is going to talk about transfer pricing in a bit more detail. But 50% or more related parties are covered within the scope of transfer pricing rules, which I'm sure Kapil will talk about in a lot more detail in his session. 5%? Participation exemption. Excellent. So you need to hold at least 5% as one of the conditions to claim the participation exemption. 12 months? Holding period for participation exemptions. This is great. This crowd, this audience is absolutely on the ball. 100%? %? I've tried to make this up somewhat. Normally, your expenses are allowed. Anything that's accounted for is fully allowable, subject to certain exceptions, of course. All expenses incurred for business purposes, barring certain exceptions, are allowed. What's the 50% in that context? Entertainment expenditure. Obviously, there is a definition of entertainment expenditure in the law. The definition, if you have noted, is slightly different to entertainment expenditure for VAT. So you do need to, hopefully things will get clarified, but you do need to be mindful that the definitions are slightly different. 30% interest limitation. 30% of EBITDA is allowed. Balance is carried forward. 10 years? Interest loss carried forward for 10 years. Right? So 10 years is when your unabsorbed interest, anything over 30%, can be carried forward and offset against your future income for a maximum period of 10 years. See how many more do we have here? 75%? Set off of losses against your income, correct. 75% of your income can be offset against your loss carried forward in your future years and your interest carried forward. Lock-in period for business restructuring, yes. So anything, if you conduct a business restructuring which is on a no gain, no loss transfer basis, and you transfer the business within 2 years, any gain or loss which was on a cost basis will get rebased to a market value basis, and you will end up paying taxes in the year of the clawback. I think 7 years. Books of accounts. Yeah, maintenance of records. Excellent, this is a good start. I don't think I need to speak anything more. I think the crowd knows everything on corporate taxes here. Excellent. No, good. I thought this is a good start. I think, I think the reason I've put all of this out is in the context of a group structure and looking at the impact of corporate tax on UAE group structures. All of these elements are relevant. All of these are relevant, and in no particular order. All of these need to be looked at in parallel. Some of the key issues that we think are relevant for group structures, and I won't go into it in too much detail. Obviously, the free zone, what is qualifying and non-qualifying income, yet to be clarified. The fact that a free zone person to claim the exemption needs to have substance, likely linked to the economic substance rules, but that is again yet to be clarified. And you need to be in compliance with transfer pricing in order to claim the free zone exemption. Tax grouping, won't go into it in detail. There's another speaker speaking on it. 95% ownership criteria, which you all are aware. Entities which are claiming the free zone exemption and any exempt entities cannot form part of a tax group. And the important part is, if you do decide to form a tax group for the eligible entities, any intercompany transactions are eliminated from that analysis. And again, I'm sure Kapil, you'll speak on it in more detail. Exemptions, participation exemptions are available. Foreign P is also exempt. Income of a foreign P can be exempt if you make an election. There is one particular impact of the participation exemption on multi-tiered structures, which I do want to touch upon, that can be quite tricky when you look at the participation exemption conditions. So if UAE company holds a company in BVI or in the UK that then has step-down subsidiaries, how do you look at the eligibility of participation exemption is again relevant to look at. Qualifying group and business restructuring relief. Qualifying group is relevant for transfers of assets and liabilities and for transferring losses within a 75% group. Business restructuring transactions, transfer of businesses to other group companies in exchange of shares, which would otherwise be taxable, are also entitled to business restructuring reliefs. Tax losses, unlimited use of tax losses is proposed under the UAE tax law. You can transfer to a qualifying group company that's 75% owned. Where you transfer businesses under a business restructuring relief, you can also take the losses relating to the business to the transferee company. There are some challenges there because losses attach to an entity generally, but there is a provision around allowing losses to be transferred along with a business. And if that happens, how do you calculate losses relevant to a particular part of the business and not the entity could be a challenge. And of course, as we just said, we just heard only 75% is offset against taxable income. Thin cap is another issue. This has been borrowed from the OECD's Action 4 requirement, where 30% interest deduction is available up to 30% of EBITDA. There is also likely to be a de minimis amount that is yet to be specified in the legislation, up to which the interest will be fully allowed without looking at the 30% limitation cap. The balance is eligible to be carried forward for 10 years. And in certain cases where you borrow from related parties, there are certain end-use restrictions on the use of the borrowed funds in order to be eligible to claim that as a deduction, even if otherwise you meet the transfer pricing criteria as well as the 30% criteria. Transfer pricing, again, applies to both related parties and connected persons. Again, connected person concept is new in the legislation. So if you're an owner of the business and you pay yourself salary, because there is no personal tax in the UAE, there is the tendency or a potential to overcharge your own business, reduce the taxable income, and therefore reduce the tax that you would pay. UAE has introduced a connected person rule in the legislation to include within the transfer pricing rules. TP compliances and documentation will increase. So, you already had the concept of CBCR, which applied to UAE headquartered groups. You will now have master files, local files, and likely a disclosure form that you will need to submit with the tax return to be in compliance with transfer pricing rules. And finally, permanent establishment. So to the extent there are foreign companies that have agency arrangements, nexus arrangements, which are yet to be defined, fixed place P, construction P concepts are there in the UAE law. You also have a very interesting concept on effective management and control that applies to foreign entities, which may be effectively managed and controlled from the UAE. And the risk is that if that happens, then those foreign companies will be regarded as UAE tax resident companies taxable on worldwide income. Now, if you look at globally, the key litigation in the context of direct tax is, number one, on permanent establishment. What is a permanent establishment? What are profits attributable to a permanent establishment? Globally has been one of the most litigated subjects. The second one, in the context of certainly the developed economies, is the concept of effective management and control. The effective management and control is not just where the decisions are made or rubber stamped, but strategically, where does the head and brain of the company sit, and where do they make the decisions, the strategic decisions relating to the company. And if that is happening in the UAE, regardless of where the company is incorporated, that foreign company is a UAE tax resident company. Now, all of these principles, I think, and there are several others. There are several others, and there are other speakers that will pick up on some of these topics. But some of these concepts or some of these principles, I think, are the most relevant when you look at the impact of corporate tax on group structure or planning for corporate tax on groups which are based in the UAE, both in the UAE and outside the UAE. Okay. With this background, what I wanted to do was I've built a hypothetical structure, a hypothetical group structure, now some of which may be familiar to you and your clients or your organizations. But if we start, and what I wanted to do is I want to show what typical groups in the UAE might have as an operating and a holding structure, and how various elements of the UAE corporate tax legislation, some of the principles we've looked at in the first slide and some of the concepts we've looked at in the numbers, how all of this could apply to group structures in the UAE in parallel. Okay, so this slide, by the end of, after the next 8 to 10 minutes, will look like an extremely busy slide. But I think it's important to consider this as we go along. So let's make an assumption that you've got individual shareholders of a UAE company. They may or may not be Emirati. Let's assume they're non-Emirati individual shareholders who conduct business through a UAE holdco. And for discussion, let's say that this UAE holdco is on mainland. That's how they set up the business. There's one part of the business which is into property. So one part of the business which is into property development and lease. So you have a propco which is set up in the free zone. Could be Jebel Ali offshore, Jebel Ali offshore, or any one of the free zones that are there in the UAE. The propco develops the property, constructs the property, leases it to the opco on mainland. And let's assume this property is a hotel. The opco pays lease rentals to the propco, and the opco earns income from individual customers like you and me who visit the hotel, we stay in the hotel, we dine in the hotel, etc. The issue to look at here is obviously, does the propco qualify for the exemption? Right? So, and this could take various variations. I heard no, propco, does it qualify for the exemption? Likely no, because the property is on mainland. Right? So unlikely you will get the exemption. The opco obviously is a mainland business, should be taxable on its income. You have a second part of the business, which is a distribution company, which the UAE holdco has set up in a free zone. The distribution company buys its goods from, let's say, a foreign connected person, obviously, and supplies it to both UAE customers as well as to its to GCC customers as well as to its own mainland retail company for onward sales to stores and consumers, etc. The distribution company is obviously within the scope of the economic substance rules also, as it has procured from a foreign group company and it is selling to both UAE and non-UAE customers. The question here is, for the distribution co, it's likely earning, it's in the free zone, it's earning goods, it's earning income from GCC as well as from mainland. Likely situation, there is an element of qualifying income. If you look back at the PCD, any income from businesses any income generated from businesses outside the UAE is likely to be in scope. So this distribution company is likely to have both qualifying and non-qualifying income, subject to 0% tax rate on its qualifying income and 9% on non-qualifying income. The challenge that comes in is what happens to the costs that the distribution company has incurred, because those costs, some of them may be directly attributable to the GCC customers and some to the mainland customers, but the more likely situation is that the costs are common across both businesses. There needs to be a transfer pricing linked cost allocation analysis that needs to be done for this free zone company that's claiming a qualifying income exemption and a non-qualifying tax that it pays at 9%. This is going to be a key challenge for the group, looking at how they can claim the exemption satisfactorily without any adverse risk of challenge from the FTA. Let's look at the other part of the business. So this UAE holdco now also has overseas activities. It has overseas businesses that it runs, and that overseas business is run through its UK holdco, which has operating cos in the UK, in India, and Bahrain. And it also has a foreign branch in Bahrain. So overseas activities could be trading, could be real estate, could be services. It renders this through a foreign holdco or a foreign branch structure. The key question here is, will participation exemption be available for the shareholding in the UK holdco? Yes, no? Yes, no, depends. Depends on the management. Depends on where the management is sitting. That's partly the correct answer, but if you just hold this question, I've got a case study on this, which we'll come back to. But the obvious question to look at in the context of your overseas activities, in this case, is there a participation exemption available for the UAE holdco on its shareholding in the UK holdco? Yeah? And the other bit is, what happens to the income of the foreign branch? Will that income be subject to tax in the UAE in the hands of the UAE holdco, or will it be exempt? One of the conditions for claiming a foreign branch exemption is should be subject to tax at an effective rate of the UAE corporate tax law. So if the foreign branch, in this case Bahrain, does not have a corporate tax system at the moment, it's subject to a 0% tax. Any income of the Bahraini branch under the current circumstances will get picked up and taxed in the UAE. Yeah? That's a Bahrain. So there's a Bahrain branch and there's a Bahrain subsidiary sitting under UK holdco. Yeah? So there are two structures. And the reason for one of them could be your Bahraini company could be a joint venture with a third party, right? Not your own, whereas your branch may be doing another part of the business in Bahrain. Then under a separate arrangement, we are all aware we had a number of 49-51 shareholding structures in the UAE, right? Very common. We've all seen it. 51% held by a local Emirati shareholder or a company owned by a local Emirati shareholder, 49% legally owned by the business. Beneficially, you may own 100% or up to 100% or 80-20 or whatever the arrangement is. The key question that comes if you have this arrangement, will tax grouping be allowed? Yeah. We all saw tax grouping requires a 95% ownership and control. Here I'm owning 100% of the economic profits of the company, but legally I own 49%. Question is, will I get the tax grouping benefit? Because I otherwise own and manage and control the company. I'm not giving an answer to this question. No, I think the way the rules currently, the direct holding of 95% ownership, unlike, I think, I'm not a VAT specialist, I know there are a number of VAT experts here. Unlike VAT, corporate tax requires, the threshold is higher, which is 95%, but it requires legal and beneficial ownership or control in order to be eligible to form a tax group, as things stand today. Obviously, unless it gets clarified in the future, under a cabinet decision, that's a separate matter altogether. We then have, under the sixth arrangement, we have a new structure where there is a BVI company owned directly by the shareholders. This is their personal investment company. The shareholders personally own a BVI company, which owns a real estate company in the UAE to own UAE real estate. It owns a real estate company in the UK to own property in London. And it makes investments at various percentages in PE funds, bonds, etc., listed securities. And the UAE real estate company procures services from the UAE subco in your fifth vertical. Could be facilities management, property management, whatever there may be a part of the business that the UAE subco can support. Yeah. Now, the other element here is there a deemed residency for BVI Holdco and the UK real estate Holdco? Yeah. So I think it could apply to both, depending on how the BVI Holdco and the UK real estate co are managed. Every client that I've spoken to that has a BVI company has never been to BVI. And I'm sure it's not an uncommon phenomenon. If the BVI Holdco is managed from the UAE, this becomes a UAE resident company. Equally, if the UK real estate co, we don't know how that's managed, but there's a question to be asked. Who and how are you managing the UK real estate Holdco, UK real estate co in this example? Is there a risk of effective management and control being tripped to the UAE? And therefore, do these companies become UAE tax resident companies? What do we have next? Now, there is, the UAE Holdco is where the management sits. The group CEO, the group CFO sits in the UAE Holdco, and it charges the management fees and all of the central costs to various entities within the business. Again, very common. Sometimes these costs are not charged, they're incurred but not charged. Sometimes they're charged purely on a cost basis. The key question here is obviously transfer pricing. Transfer pricing will apply to the management fees that are paid. And actually, if you look at even the vertical number 6, where there are fees, service fees paid from the UAE real estate co to the UAE subco, if you look at the definition, even though there is not direct ownership of BVI Holdco under UAE Holdco, under the related party definition, this would also be an arm's length. This will also be a related party transaction which will need to be benchmarked and documented on an arm's length basis. There is also directors' fees and sitting fees that are paid by the UAE holdco to its ultimate owners. Again, very common. Transfer pricing will apply to both of these arrangements. And then finally, if you look at this group, the question here, besides looking at all of the elements of UAE corporate tax that will apply, is what can I form as a tax group? So if you see the ones with the stars, they are all eligible to form a tax group. Does anyone disagree? Why is the distribution co not eligible to form a tax group? It's a free zone company. It's claiming the exemption. Unless it gives up the exemption and elects to be taxed under the tax regime, it cannot form a tax group. What about the UAE subco? 49%, and it's not 95%. What about the UAE real estate co? Why is that not eligible? UAE company is not subject to 9. I'm not about the BV, I'm about the UAE real estate co. Why is that not eligible to form a tax group? So the shareholder, in order to be part of the tax group, the parent and each of its direct and indirect subsidiaries should be 95% owned. In this case, the UAE real estate co is not 95% directly or indirectly held by the UAE parent, which is your UAE holdco in the example. Everyone agrees? Now, what if my UK holdco and BVI holdco were managed and controlled from the UAE? UK holdco and BVI holdco are managed and controlled from the UAE. They become UAE tax residents. You can arguably group the UK holdco, but not the BVI holdco for the same reason as we can't group the UAE real estate co. Does everyone agree? We could have gone on, but I've run out of space on this slide. So you can see how with a group structure like this, now many groups in the UAE will have structures similar to this or variations to this structure. But the relevance of looking at all of these aspects of corporate tax that we've talked about in the context of group, UAE groups and UAE group entities, foreign group entities sitting part of the overall group becomes relevant. Yeah. I've got a few, I don't know, time permitting, 5 minutes? Okay. I've got 1 or 2 case studies which I'll run through. We are running out of time. Ideally, I'd stop here. I just want to run through the, maybe we want to run through the participation exemption case study because that's relevant to the 4th vertical that we talked about here. So maybe I'll just pick that one and stop on that. Okay, so I'm just going to move. Okay, so here you've got UAE holdco, which owns shares in a UK holdco. Will the payment of dividend from UK holdco to UAE holdco be eligible for participation exemption? Yes, because all the conditions should be satisfied, 100%. Let's assume the 12-month period of holding, and UK is taxed, corporate tax rate is 19%, so it ticks all the boxes. What if UK holdco had entities underneath it? It has a UK sub, which it owns 4% of, and it has 80% in India co, where the tax rate is 25.1 and 19. Will this apply? India co yes, UK co 9. Now, the answer could be as you've said or may not be, and I'll tell you why. The investment by UK, the UK co has 100,000 dirhams to invest, and it has invested 60,000 dirhams for a 4% stake in UK subco and 40,000 dirhams for an 80% stake in India co. you will not get participation exemption at all. Why is that? So there is 23.2D, yeah? 23.2D says that not more than 50% of the direct and indirect interests of the participation must be in interest that would otherwise not be eligible for a participation exemption. Bit of a tongue twister, but if you read it in what it essentially means, that you need to look at what is the investment of the UK holdco. What percentage of its assets are in participations that would otherwise make the UAE entity eligible for participation exemption. So in this case, if you didn't have the UK holdco, if you ignored the UK holdco, and the UAE holdco had directly invested 4% or 60,000 dirhams in 4% stake, it would have not got the participation exemption. Yeah? Scenario 2, we flip this. The UK sub, the 40,000 was now invested in UK sub at 4%, and 60,000 was invested for an 80% stake in the Indian company. Remember, the participation exemption we are asking about is the exemption in relation to dividends paid by UK holdco to UAE holdco still. That's the transaction we're looking at. Under this situation, will you get the exemption? Yes or no? Will the dividends paid from UK holdco to UAE holdco be eligible for participation exemption? Yes, because more than 50% of UK holdco's interests are in India, which satisfies all the conditions. Say you had a Bahrain holdco. I'm going to run through this quickly. UK holdco had 100,000 dirhams. It has invested 30, 40, and 30 in UK, India, and Bahrain. No, because 60,000 dirhams are invested in UK and Bahrain, which do not satisfy the participation exemption conditions. And finally, we've got a US subco as well. 70,000 dirhams is invested in India and US that meet the participation exemption conditions. So I think the idea of this slide is not to overly complicate this, but the importance of looking at the structure beneath the immediate shareholding. If you read 23.2D, it might seem like innocuous and something that may or may not apply, but you do need to look at the multi-tiered structure for claiming participation exemption even on the principal transaction, which is dividends or gains from UK to the UAE. Yeah. I get very passionate about tax, so I could go on all afternoon, but I think I'm going to get kicked out of this auditorium. Sorry, I'm just going to move on. We don't have enough time. Sorry about that. So the key takeaways really from my slide is look at your UAE and non-UAE group entities, the effective management and control test, where are you taking decisions? Look at your tax grouping options, and then there's a session later this afternoon to talk about tax grouping. Tax grouping obviously has the benefit of one tax return and administrative relief and intercompany transactions eliminated, so obviously it's beneficial to look at that. Qualifying income, I mean, that's a no-brainer. I think we're all eagerly awaiting the guidance on this. But along with the qualifying income criteria, you need to look at substance, transfer pricing, and all of the other elements also to make sure you satisfy the rules. Identify your related parties and connected parties. What transactions have you entered into with these parties, and perform your transfer pricing analysis. Again, Kapil will talk about that in a bit more detail. Look at your holding structure to see whether participation exemption applies. If you followed the example I gave, the relevance of holding structures become even more critical in the context of the definition and the criteria and the conditions for participation exemption. Tax losses, look at whether you are in a 75% group, can you transfer losses? And I think, I had a case study which covered this, but given the time, we're not going to go through it. But obviously look at your tax grouping and qualifying groups for 75% transfers. Interest calculations, 30% of EBITDA. What may be interest for your EBITDA purposes may not necessarily be interest under the UAE corporate tax law. There could be disconnects, so look at that calculations carefully. And if you're doing any restructuring, transferring assets, transferring businesses to group entities, third parties, where you've claimed the exemption, obviously see what happens to that asset or what happens to that business within the next 2 years, because otherwise your exemption could be clawed back. Yeah? And I think therefore, given that we are in February, there's 9 months left, 10 months left for the law to come in and sooner for some other groups. I think the one message, given all of this that we've talked about, and we will talk about in the afternoon, the one message that I'd like to leave this audience with is really to start now. For your group, start now. If you're advising clients, get them started now before the tax law comes into place. Otherwise, we still don't know the exact penalties under the law, but hopefully, that's linked to the tax procedures law, and from what we know about the FTA, they'll be knocking on your doors even before you realize it. With that, thank you very much. Thanks for your patience and your participation. I look forward to meeting as many of you as possible. Thank you.
Thank you very much, Nilesh. Like I mentioned, tax grouping is not just for the holding and subsidiary structure. We need to examine and evaluate various multiple options. So let us have a big round of applause for CA Nilesh Asher. Now I would like to invite our chairman and vice chairman, CA Harikishan Rakawat, at the stage to felicitate CA Nilesh Asher. Now it's time for the one, like I always said, who's leading from the front. Let us hear what's in his kitty. So we may be expecting the election circular very soon. So is this our last event for this committee, other than AGM, or we have something more in place? So let us welcome our chapter chairman, C. Anurag Chaturvedi, at the stage.
I would like to begin today by saying that let's raise ourselves and pay regards to each one of you for your active participation in the triumph of 10th consecutive Best Chapter Award to ICAI Dubai. Your applaud will make a statement today, friends, and what we have reflected to the world. The members of Dubai chapter have achieved the knowledge center of ICAI, the vibrant chapter, the most enthusiastic chapter, and I think the most fashionable and colorful chapter of ICAI across the world. Because you all dress so well nowadays, this glory is all yours, this journey is all yours, friends. So let us all celebrate today this 10th consecutive Best Chapter Award of ICAI, along with my fellow former chairman, C.A. Sundar Nurani ji. Sir, please come on the stage. Big round of applause, friends. Say a few words, sir.
In fact, after April 2022, I am coming for the first time because we have been traveling, so not getting enough time. But I have been watching the activities, marvelous job by Anurag and the team. Wish you all the best. And I like the last statement. If you don't prepare now, I think you will fail. This is a message the experts has given on tax. There is plenty of opportunities to all of us, and I am very happy to see the hall full of all the professionals. Plenty of opportunities, and I do believe that more import of professionals will come from India also. So wish you all the best, and as Anurag ji mentioned, this award is for you because of your participation, because of the encouragement. I can see some people sitting there also. Because of your encouragement, house full. Because of the encouragement, we are able to do much more. And definitely the next committee, will do even more. The next committee will do even more. That is how the chapter's legacy has passed on. I could see some of the past chairmen, Naveen Sharma ji, I think probably Anish ji is here, or some of the other past chairmen. We learned from all of them, and thanks to all of you also. Thank you.
Thank you, Sundara. Thank you so much. Can have the XCOM for the picture, please? So friends, all these people have put together so great effort, so big round of applause to everyone.
May I request a standing ovation to the XCOM if you don't mind, so that you will get refreshed also.
Former Chairman, Vice Chairman Sri Harikishan Rankabat, dear members, invited guests, good afternoon to each one of you. Well, friends, one thing that I want to begin with, as we heard about the taxes, very important thing that I want to pass on today to you all, that knowledge is the eye of desire. Called knowledge is the eye of desire and can become the pilot of your soul. Because you are the greatest investment of yourself. You are the greatest investment. The more you store in your mind of yours, the more you enrich your experience, the more people you meet, the more books you read, and the more places you visit, the greater is the investment in all that you can make. Everything that you add to your peace of mind and to your outlook upon your life is added capital, and no more but yourself can dissipate. So let's talk on today what the think tank is all about. Friends, when I think about curating this entire event, my idea was, like, we all know about corporate tax. We have read the law as we discussed this morning and this afternoon about it. But how many of us has deep dive in this law? How many of us? How many times you've read the law? Maybe 1 time, 2 times, 3 times, 4 times. But is that sufficient? Look at the people, look at the expert when they come and talk to you on the critical aspect of the law. How they build up their knowledge. They build up the knowledge because they read the law 100 times. They read each and every provision 100 times, revise it time and time again. They go to the clients, understand their situation, and bring out that thought, curate that solution around it, and go back to discuss again. So my idea of this think tank, create this name, was to enlighten each one of you that the law and this knowledge can only be embraced once you put attention to every single word that is written in the law. And that's how, thank you. You can clap if you want. And that's why when I talk to all the speakers today, trust me, you ask them, I said to them, I said, look, I don't want theoretical session. Because my all audience, they're very knowledgeable, because the mantra of this entire year was spreading knowledge, creating goodwill. So I'm sure that you all understand this entire thing. So the speakers today, they brought out the real life examples which they face at their clients. Even going forward, other speakers that you listen to them, they'll bring out that experience that they have seen at the client, understanding their challenges, understanding the nitty-gritties of the business. And that's how they are going to impart the knowledge, friends. So what you all expect, I want to ask the question, what all you expect from the speakers? I think the more important thing that you want to understand from the speakers are there, how to frame the questions. Isn't it that true? Okay, so while I was preparing my slide and obviously the speech today, I wanted to ask a question. How many of you have remembered the very first message that I shared with you when I took the charge as a chairman? What I really wanted to achieve with all of you throughout the year. I think I was expecting from each one of you that you will become bold. You'll not shy away from asking the question. So did we achieve that throughout the year? Yes. Friends, what happened? You don't believe that you're still shying away from asking the questions? How many of you are still shy from asking the question? And how many of you, because my next pointer on that relation will going to reflect whether you are a professional or not. Because if you shy away from asking the questions, then you are not a right professional. If you believe that asking a question can diminish your accountability or your reputation, then you are not a right professional, friends. The think tank name is just because to make you aware that ask the right question makes the best professional in the world, friends. Best professionals. All our people, all the speakers, whether we talk about Nilesh, whether we talk about Manu, whether we talk about Sundarji, whether we talk about Manojji, or whether we talk about me, we never afraid from asking questions. Because the question defines your integrity, your intent, your commitment towards the people that you're serving out there. So will you all gonna shy away from now, or gonna, like my term is going to end, so you're gonna say that, look, from today onward, I'm not gonna shy away. How many of you agree with this? Raise, and I want 100% hands to be raised, friends. That's it. I think this is where exactly I wanted to make the statement to all of you, that in the tax world, ask the question. That's the most important thing, I believe, that a professional can do to themselves and to their client. Because knowledge is an antidote of fear. Okay? So once you have knowledge, you read time and time again, you don't have to fear because you have antidote of fear. All right? So what's the next? As this term is going to be ending soon and finishing soon. So what else you expect, friends? I think we have done most of the things. We have done a lot of entertainment. We have done a lot of knowledge series out there. We covered, the latest regulations. We've done study tours and every single thing. So I believe, let's say there's quite a few more weeks left out there. So what do you expect? More knowledge sessions or some entertainment as well? Sorry? Louder, please. Come on. Knowledge sessions. All right. So knowledge session is ongoing. We are doing the TB, the corporate tax classes. So I believe one last event that we need to do is again bringing the families together because they back you. And we wanted to ensure that they stand by you in your knowledge sharing session. So more knowledge sessions can continue should your family get involved as well. So the team has put together a social get-together on 25th February, this Saturday. I think that's going to mark the last event of this term before we announce, the AGM circular. So that social get-together will going to happen on 25th February. And the venue will be announced soon. It will be more convenient venue and much more structured because we'll take care of parking and all your food stuff and your demands, So we are trying to do that, friends, as well. And since this is again a formal event, I would like to make an appeal to each one of you, friends. ICAI Dubai, the entire world talks about it. Wherever I go, whichever city that I go, whether it's branches, overseas offices, ICAI council, anywhere that you go out there, the kind of respect that you achieve is tremendous. I can't express my happiness and I can't express my gratitude to each one of you to give me this opportunity to serve the chapter. And just to tell you that the next committee will gonna come in, I want to encourage each one of you to prepare and spare some time to serve the fraternity. Because the joy of serving the fraternity is beyond any thoughts, friend. Beyond any thoughts. I can't tell you that how much indebted I am to each one of you for having this opportunity and standing here to share and talk to you, each of you. It's incredible thought and it's incredible feeling that I have from all of you. So definitely, friends, I encourage each one of you to think about it because still we have 3-4 weeks to go in time of AGM circular. So prepare yourself if you wish to come forward and serve the fraternity, right? And I think this is where I wanted to pass on the thoughts to you. Knowledge, goodwill, fearless, don't shy away. These are some of the tricks a professional should have if you wanted to have agility in anything that you do, friends. With this, thank you so much to listen out to me. Thank you so much.
The way you concluded, I thought it's your emotional and last speech. And thank you, Chairman Sahab. Like he said, and generally we see the issues in parking and all. So we are working very hard on that. Now moving to the technical session, how many of you know that, or which is the one of the most critical aspect in UAE corporate tax law? मेरे हिसाब से भी बोलो transfer pricing. So you know how much percentage of the tax law, why it is so critical? Sir, you are replying the whatever I teach in the class. So whole chapter 10, 34, 35, 36, 55, 61, you see total 70 articles are there and 6 are for transfer pricing. So this is the most critical aspect. And to make it simplify, today we have with us Kapil Bhatnagar, Director WTS Dhruva Consultants, Middle East TP Leader, WTS Global. And to introduce Kapil, I would like to invite our Treasurer RCA Jayaprakash Agrawal to the stage. Taliyan.
Thank you, CM Manoj Agrawal, Secretary of the Chapter. Success for the first time can be mere luck, but success for 10 times in a row is sheer hard work and efforts. Please clap for all the 10 committees. It's not the current committee and the past committee. All the 10 committees ensured that this is done for 10 consecutive years again and again. You have to clap again for yourself, because committee cannot do if members are not there to support. So support for yourself, because 10 consecutive years is because of this hall, because of the people who could not join. And I can see there, sir, you can also clap because this 10 years is coming because of you. Thank you, everyone. And we will try to do our efforts, but we'll need your support. This is for you guys. Please take your pictures after the session. These trophies will be here. I want to see you putting up these, saying ICAI Dubai chapter for the 10th year has won it, because it's collectively all our efforts. Together we have achieved it, and we should celebrate it. Now, let's go to the topic for the technical session. Kapil Bhatnagar will be speaking on transfer pricing simplification. Let me introduce Kapil to you. Kapil is a director with WTS Dhruva Consultant and Middle East Transfer Pricing Leader for WTS Global as well. He has over 18 plus years of experience in international tax, transfer pricing, PE attribution, inbound and outbound entry-exit strategies, and various planning assignments. He has worked on several complex transactions, including royalty planning, IP transfer, structuring of overseas operations, marketing intangibles, setting up of TP policies, global documentation, and a variety of complex benchmarking assignments. He has served clients in the retail, real estate, education, pharmaceuticals, automobile, and FMCG sectors. He is also a frequent speaker at technical forums on taxation and regularly contributes articles to International Tax Journal. He is also a lawyer and holds a business finance diploma from Belgium. Can we have a round of applause for Kapil Bhatnagar to speak on topic transfer pricing simplified?
Thank you so much. Thanks a lot. So I just heard, one of the key aspects or the most important thing in the corporate tax law is transfer pricing. Very true. India, for example, sorry, I just need that. Thank you so much. Now, if you look at the India tax law, it runs around 1,000 plus pages. That's something which we've all read in our, when we were learning and we were doing our chartered accountancy firms. Transfer pricing in that particular act is like just 40 pages or 50 pages. Yet, the transfer pricing disputes in India, we are very well aware, they are so significant and they are huge that multinationals have now realized that transfer pricing as a subject cannot be taken lightly. My attempt in this session today is to simplify some of the critical aspects which we've seen over the years interacting with our clients, how well we can prepare ourselves and our clients and our organizations in terms of preparing that readiness. Like Nilesh said, let's be prepared. And that's the theme which we want to really touch base upon here, to say that how do we simplify the compliances for transfer pricing? How do we simplify our efforts to do benchmarking analysis? Before we start, just wanted to give you a background of how transfer pricing really evolved. Not really in UAE, but the sense that in the UAE, in the last few years, we've seen a host of regulations coming in. We saw CBCR, which was introduced in January 19, followed by an ESR. There were two big regulatory announcements also there, the ultimate beneficial ownership regulations as well as the AML. Now, all these regulations really paved the way and laid a foundation of an environment which is more tax-friendly and tax transparent. The CBCR and the ESR comes from the OECD guidelines, the minimum standard regulations, and UAE was thinking of implementing those in order to remove themselves from the grey list of the FATF and the European Union. So what is transfer pricing? We all may be aware that transfer pricing is applicable whenever there are transactions between related parties. Now, there is a definition of how related parties are classified. There is a concept of a domestic transfer pricing regulation to be built in, wherein even transactions between two similarly taxed companies or group companies would also need to ensure that transfer pricing regulations are to be adhered to. Even from an international transfer pricing perspective, whenever there is a cross-border transaction, even those transactions need to get covered. OECD is one of the organizations which comes up with this OECD transfer pricing guidelines, which are pretty much detailed. The UN has also come up with a detailed transfer pricing manual, which again gives a detailed analysis of how transfer pricing principles need to be applied. And the UAE has adopted the OECD guidelines in order to formulate its transfer pricing regulations. We are awaiting certain details from the ministry to announce in terms of the benchmarkings, in terms of the periodicity, the form and substance of the local files. But as an overarching principle, the OECD guidelines would be followed by the UAE whenever the transfer pricing regulations come into place. The UETP regime talks about that they are applicable on related parties and connected persons. Connected persons, there is a list of people who would qualify as connected persons. They are primarily business owners, their relatives, directors of the organization, etc. And any payments being made to them would need to adhere to the transfer pricing principles. We have a case study later in the stage to really talk about how we will tackle that particular challenge. Domestic transfer pricing is also applicable. It has been clarified by the FAQs, which means that two mainland entities subject to a 9% tax rate would still need to comply with transfer pricing. A free zone claiming a 0% exemption and a mainland entity claiming, opting for a 9% would need to adhere to a transfer pricing provision as well. The definition of control has been specifically defined in the regulations. There are certain differences between what control really means from a transfer pricing perspective vis-a-vis what control really means from an IFRS perspective. The scope of TP provisions is far more than what the IFRS really says as related parties or connected persons. And hence, whenever we are looking at any analysis, the first thing which we should do is to look at our related party schedules in the financial statements of our clients. But that should not be the only stop, because that's just the beginning. We need to dig deeper into the relationships, into the ownerships, into the beneficial ownerships to ensure that all related parties are mapped and their transactions are held at arm's length. The transactions have to be at arm's length value, which means as if they are interacted between two third parties. There are 5 OECD methods which are prescribed, which are adopted globally. Additionally, there is another method and any other method being prescribed by the UE regulations to say that if the taxpayer believes that the 5 methods cannot be reasonably applied to justify an arm's length price, the taxpayer is free to use any other method, which is a residuary method. And let me tell you, this becomes really, really handy in terms of benchmarking certain complex transactions, and particularly in a case when there are salaries and payments made to business owners. And we'll see in the upcoming slides. Another interesting thing which has been provided in the regulation itself is that a combination of methods can be used by the taxpayer to justify the arm's length price. So the taxpayer is not just stuck to a comparable uncounted price method or a cup. They can do a dual level justification of the arm's length price by using a combination of methods, which really gives an additional layer of defense in your local file. And the authorities will have bigger challenges to countering you when you have 2 methods justifying your intercompany transactions and determining the arm's length price accordingly. The authorities have the power to make transfer pricing adjustments. If the authority believes that the transactions are not held at arm's length, they have the powers to make a transfer pricing adjustment. Yes,
a relief has been provided that if an adjustment is made in the hands of one of the taxpayer, a corresponding relief will be provided in the other entity, which really eliminates the effect of double taxation. The payments to connected persons will be subject to transfer pricing. There are certain exemptions, and the exemption is that if the taxpayer or the company shares are traded on a recognized stock exchange in the UAE, any payments being made to those connected persons of that company or that taxpayer transfer pricing provisions will not apply. Now, this is a very big relief for listed companies, companies whose shares are traded on the exchange. And the rationale which one could really think of is that companies like these, you have independent directors, shareholders, minority shareholders, audit committees, who really approve these sort of payments to owners, business owners, directors, and hence that payment is already tested or has been looked at by a third party, hence arm's length. And that's the rationale. Possibly the authorities have come back to say that taxpayers with such kind of actively traded shares on a recognized stock exchange, no transfer pricing typically applies. If the payments to connected persons are to be tested for transfer pricing, they need to be held at market value, which means that any payment which is there, you need to have a comparative market rate to that. And the challenge really becomes that when you are paying a salary to a business owner, how do you benchmark it? Because a salary to a person is really dependent upon the skills, the experience, the value the person brings on the table for the business. And how do you really compare those, those payments being made to these business owners? That is something which is really a point which our clients have been talking about, and we really have certain solutions around it as to how to benchmark such kind of payments. In terms of the transfer pricing compliances and documentation, the OECD 3-tier documentation needs to be followed. CBCR was already in place since January 2019. A master file and a local file will also need to be additionally maintained. The master file is a global concept released by the OECD. The format for the master file is already there in the BEPS Action Plan 13. The local file, yes, the format is again available in the OECD guidelines, but a customizable template or a format specifically for the UAE is something which we are waiting to be announced. So what are the UAE transfer pricing documentation requirements? There are 4 documents which would need to be maintained. The TP disclosure form and the local file, which are to be maintained at the entity or the taxpayer or the tax group level. Then there is a master file and a country-by-country report or a CBCR report, which needs to be maintained at the group headquarter level. So it's something which, at least for clients, really becomes very, very important to identify what is their filing obligations. Even though the master file and the CBCR are group level compliances, individual taxpayers, individual entities need to feed in data to help the group to really prepare the master file and the CBCR. And we'll come to the details in terms of what are the constituents of these documentation. But then what is very, very critical is that the clients, the organizations, and the finance teams and the business teams are educated to say that while a master file and a CBCR may not be your filing responsibility and obligation, but the data which really goes into the master file and the CBCR is something which you need to provide to the HQ, and that's something which will really ensure that the compliance is done on time. So what is CBCR? A country-by-country report talks about financial data to be reported by a multinational, where the turnover of that multinational is 3.15 billion dirhams or more. Globally, this threshold is set at euro 750 million, which means that if a UAE headquartered multinational breaches a threshold of 3.15 billion dirhams, they need to file a CBCR on the Automatic Exchange of Information portal in the UAE. Why I'm saying a UAE headquartered multinational? A Pepsi having an operations in UAE need not file a CBCR. But for example, let's take an example, EMAR, could be a UAE headquartered multinational. They need to file a CBCR in UAE. A Xerox, a Canon, are not required to file a CBCR, not even a notification. So the concept of a secondary filing is not present in the UAE. It's only UAE headquartered multinationals. And hence, if you have a headquarter outside the UAE, could be a Cayman, BVI, UK, etc., CBCR regulations may not typically apply. It's a two-part compliance. A notification and a report needs to be filed. The notification has to be filed before the end of the fiscal year in which CBCR regulation applies to you. The report needs to be filed within 12 months from the date of the end of the fiscal year. The CBCR report talks about jurisdiction-wise, entity-wise, tax details, number of employees, incomes earned, intangibles held, the activity, business activity. And it's a very detailed document and really involves a separate discussion altogether, which really gives the authority a clear snapshot of how the group is structured, where they have actually parked profits, and where their substance does not lie. In terms of the master file, a master file is a detailed document which talks about the intercompany pricing policies of the group. Remember, there is no benchmarking analysis in a master file. It's just pure play detailing out the supply chain of the organization, where are the major locations, who are the major suppliers, who are my customers, top 10 products, top 10 geographies. What is my intercompany pricing policy? When I'm distributing or let's say rendering a service to a group company, whether I'm charging cost plus 5 or whether I'm charging a cost plus 10 is something which needs to go into the master file. If there is a contract manufacturer in the system, at what rate I'm remunerating the contract manufacturer? If I have an R&D division in India, at what cost plus rate am I remunerating that R&D division is something which really goes there. Who owns the intangibles? Any intangibles being created over the years, who is the owner, who's developing those? All those details really go in the master file document. In terms of the local file, a local file is as popularly known as a transfer pricing report. A TP report or a local file talks about the entity per se, or a taxpayer per se, which would really mean a master file was talking about the entire group, but a local file talks about that particular entity and that taxpayer, which would really mean what are the functions. So in our example which Nilesh gave, the distribution entity in a free zone will prepare a local file on its own. A real estate company in the mainland will prepare a local file on its own if it is not tax grouped or grouped with another group companies. Then for the entire tax group, we will have just one local file. But in substance, the local file is a single document, a detailed document, which would talk about the functions being done by that particular entity, the assets they've employed to earn that, what are the risks they are taking to really generate revenues from the business, and it is a much more detailed, and accordingly, a benchmarking analysis also needs to be maintained in the local file. So all your benchmarking analysis will not go in neither in your CBCR nor in your master file, but your benchmarking analysis would typically come in something which is known as a local file. When we looked at the compliances, there are certain transfer pricing business models, and given the experience we've seen over the years in the Middle East, what we've done, we've tried to map each and every business model, and we've tried to also suggest what could be an optimal transfer pricing policy for that business model. The underlying principle in transfer pricing is the more the functions, the more the assets employed, and the more the risks an entity is taking, the higher the remuneration or higher the profit margin that entity is entitled to in the supply chain. So for example, in your supply chain, you have a 20% margin right from production till the customer. Then you need to break down piece to piece, entity by entity, by saying that which entity is doing what activity, what value add that entity is doing in the supply chain, and basis that value add, the profit which is being retained in that entity, whether it is arm's length or not. If you've cracked that code, you will have a very robust TP policy, which will be very hard for the FTA or any tax authority across the globe to really challenge. So let's look at certain models, and we've picked up distribution, manufacturing, and services, 3 big models, and we'll see what are the different areas and the TP models which we see. So in distribution, you have a market support service provider, you have a commission agent, you would have a low-risk distributor, and you will have a full-fledged entrepreneur. These are the 4 broad categories in which a distributor would typically operate, right? And what we've done is to map what could be the functions and risks of each and every entity, each and every business model, whether they do perform it fully, partially, or they do not perform at all. And what would be the possible transfer pricing model for them, basis their function analysis. Obviously, needless to say that this needs to be customized basis your clients, your organizations, facts and patterns, but this could be a good reference point to really talk about and initiate those discussions. So typically a market support service provider is just an entity which does market research and customer identification. They don't really go out in the market, do advertisement idly. They do not go into the negotiation of prices, no conclusion of contracts, no creation of intangibles, etc. etc. So the only 2 key functions with which a market support services entity or an advisory company would really do is market research and customer identification. And hence, the TP model, which is relevant for them, should be an assured cost plus. Pick up their costs in their P&L, add a 5%, 10%, 15% markup, whatever comes up from the benchmarking analysis, and that is something which ideally should be their transfer pricing model. Similarly, for a commission agent, yes, they would do a market research and a customer identification. They may also sometimes discuss negotiation of prices, be a party while conclusion of contracts. They may also assist partially into marketing and selling, but all the other key functions and the risk which relate to credit and market, they will not be exposed to. And hence, typically, for them, an optimal transfer pricing model would be a low commission percentage on sales. When we talk about a limited risk distributor would again do market research analysis, but would also do inventory management, title to goods, may also be involved into logistics planning, marketing and selling, but it would not really create marketing intangibles. It would not conceptualize a marketing strategy for the entire group or that product. A limited risk distributor typically gets this from the group companies and implements it. And accordingly, for a LRD, an optimal transfer pricing model would be a guaranteed return on sales, but that too on a lower side. It really depends upon what the functions this LRD is typically doing. Similarly, a full risk distributor is like an entrepreneur. He's doing end-to-end everything, right from conceptualization of what product needs to be sold in the market, to creating the strategy for marketing, hiring brand ambassadors. They do it all, and hence, typically, they are entitled for a supernormal profit. Yes, they are also entitled or eligible for a loss when it happens. So a pandemic hits, this guy is going to hit first because the balance others are on an assured margin basis. Now coming to manufacturing models, we see a toll manufacturer, a contract manufacturer, a licensed manufacturer, and a full-fledged manufacturer. Those are the 4 broad categories of manufacturing models we've seen in the in the past. And typically, a toller would just manufacture. He gets the product, he just manufactures. He typically takes flash title of the raw materials or the products which are to be, to be manufactured or reprocessed. Apart from that, no risks, no activities, no marketing is something which a toller typically does. However, and then again, the remuneration model for a toller is an assured cost plus because he's insulated from all the risk. He's been set up for a specific purpose by the entrepreneurs to say, we'll give you product, you toll manufacture it and you send it back to us and the clients. Accordingly, a contract manufacturer would have an additional responsibility of doing inventory management. They would take the inventory, create a warehouse, do the manufacturing, but all the other activities is something which a contract manufacturer would typically not do. And again, for a contract manufacturer, ideally, a transfer pricing methodology could be an assured cost plus or a gross margin. A licensed manufacturer is something where you typically get an IP from an overseas company to license and manufacture those licensed products in the market. So for example, if let's say Apple gives to any of the licensed manufacturers a license, for example in China, to manufacture iPhones, that is an licensed manufacturer who would be doing all these activities typically except creation of marketing intangibles. Marketing intangibles is something which is still the responsibility of a full-fledged manufacturer or a entrepreneur. And typically, for a licensed manufacturer, a return on sales is the most optimal or a suggested transfer pricing model which they should ideally follow. And similarly, for a full-fledged manufacturer, they would do the entire set of activities and hence would be again subject to a supernormal profits or a supernormal loss. Coming to the services, we have a captive service provider, we have a shared service center within the organization rendering services to group companies. We would have routine service providers, which are generally I reach out to any facilities management guy, get those services, and it could be an entrepreneur or a full-fledged service provider. Typically, in terms of the activities, a captive service provider would be required to provide services and quality assurance. Those are the two key activities or functions which typically a captive service provider would typically. All the call centers which we see, which are remunerated on a cost plus basis, the Converges, the EXLs of the world, the Genpacts of the world, fall under this category of a captive service provider. Then you have a shared service center, and then again, it is remunerated on an assured cost plus. Then we have a shared service center where you house senior people of the organization, the treasury team, the finance team, the tax team, the procurement team, for example. You could have a centralized procurement team managing your entire procurement for the entire group. You could have a merchandising team, you could have a branding team, an advertising team. If they are housed all together in a shared service center, then typically the variation of services come into picture. The setting of prices at which the shared service center should ideally charge to group companies becomes their responsibility. Yes, the management does have a say, but typically that really becomes their responsibility. And they are required to hire a sophisticated workforce also to a very large extent. Some functions like IT, etc. could have not specialized workforce, but then they are required to have these kind of people in their organization to really render those services. If you are a shared service center, again, the suggested TP methodology is assured cost plus. When you have a routine service provider, it would do everything under the sun except for creation of intangibles, because it is working under the obligation guidance of a third party or on the obligation and guidance of a related party who's set all these processes. Now you would see a lot of companies in our free zones which are in DIC or in DCOM, and they are rendering services to mainland. Now, all these routine service providers typically work on the set principles laid out by, let's say, an IBM US or a Oracle US, and typically they are nothing but typically a routine service providers. And for them, a cost plus markup or an hourly charge out rate is something which could be a most appropriate TP model. And needless to say, a full-fledged service provider would typically do all sorts of activity. And again, this guy gets the entire supernormal profits or the losses which are incurred in the supply chain. So these were the broad three categories of distribution of models which we've seen, business models, and how we can come up with an optimal transfer pricing. When we are suggesting our clients, yes, all these need to be on a fact basis, fact-specific basis, and that is where we need to get into a more detailed functional analysis, interview of people, interview organizations, and understand what are the kind of functions which they are doing. Sorry. We have certain case studies, and I think one of the big ones is that what about payments to connected persons? How do we benchmark it? Any conversation we've been having with our clients, everyone says, distribution, we'll see, we know what margins there are. But how do we benchmark payments to connected persons? So we have an example where an ABC UAE has a connected person, and there are salaries, rents, perquisites, and interest on loans being made to this connected person. Now, how do I determine an arm's length price for this? Any suggestions from the group? Any interesting thoughts from the group before we delve into certain ideas where we've talked about, but any suggestions from the group in terms of how they've advised their clients or looked at how do we will manage this challenge? Please.
So one angle could be we could just ask the recruitment agency for salary partners or directors in similar industries.
Right.
And then we can just furnish that recruitment report
Mm-hmm.
we got from the agency that, people, directors, partners in similar industries. Hi everyone. So the one angle could be that we could reach out to the recruitment agencies and ask for the salaries for these partners or directors who are operating in similar industries.
Right.
And then once they create a recruitment report for us, we can furnish it to the tax authorities and say, yeah, in similar situations and in similar industries, these people are getting a salary range between X to Y.
Yeah.
And our directors or partners based in our groups are with this salary range, and we conclude that they are at arm's length.
Perfect. That actually is one of the ideas. And what we can do is that salaries and perquisites, like you said, can need to use the any other method which is being provided in the regulations and provide a business and a commercial rationale to it. You have salary benchmarks available on websites like Glassdoor. What the lady is saying, you reach out to individual recruiters. There are websites which talk about salaries in an organization, in an industry, what are the general ranges. You could pick up those and use them as a comparable and controlled price method. One interesting point which came when we were discussing with one of the directors of a senior organization, and we suggested him that before becoming a connected person, before signing that appointment letter, you were a third party. You were not a connected person. Can we build that rationale in our documentation to say that I became a connected person only after I said yes to a salary negotiation? I signed the appointment letter, and that appointment letter could be 2015, could be 2016, which means the pre-tax era. But then again, from 2015 to 2016, the increments in my salary are as per industry standards. And hence, whatever payment is being made to that connected person is arm's length. Because at the time of entering into the contract, I was a third party. Whatever the organization has given me on a year-on-year basis is as per industry benchmarks. and hence why is this payment being challenged now? And that is where your sixth any other method comes really, really big into picture to justify your salaries and payments to connected persons. Rent payments. You have Dubizzle, Biotes, and other websites available. So you're making a rental payment to a business owner who owns the building. Find out on Dubizzle or on Biote a similarly priced, similarly located business unit. Take out that printout, use it as a benchmark. Interest on loans. Owner has given a business loan, compare it with bank. So a bank could have also given a loan to the business. A owner cannot fund from its own funds the entire business. There could be areas where typically a bank has also provided a similar loan to the business. Use that as a comparative method. But any significant increase in the payments right before the tax law is announced is something which is going to be scrutinized very heavily. So a business owner cannot just stand up today and say, okay, the tax year for me starts from 1st January 24, 31st of December 23, I'm taking $2 million as salary, and that is salary something which is going to be there till perpetuity. Now that is something which is going to be challenged because it has to be as per industry standards. Yes, you can give $2 million salary to the business owner, but there has to be a business commercial rationale as to why such a high payment and to why such a high increase just before the introduction of the corporate tax law. We have another case study on distribution. So we have a ABC UAE, which is in a free zone. They sell goods to XYZ, which is a third party in USA. They also sell goods to a related party in a UAE mainland, which then sells these goods to third party. And this free zone entity also sells goods to the third party customers in the UAE mainland. Now typically, what the authorities may come back and say is that the prices at which ABC UAE free zone is selling to the related party in mainland has an internal cup available because it's selling the same products to a third-party customer in the UAE mainland. And accordingly, the comparison of the prices between a third party and a related party will be tested, and that needs to be justified using the cup method. Accordingly, what they may also come back and say, so while you may say that the products are different, right? I'm selling product A to my related party in mainland, I'm selling product B to a related party, to a third party in the UAE mainland, hence not comparative. Then they may come back and say, the functions performed by the free zone are of distribution. And hence, I will not do a price level testing, but I will do a margin level testing, and they will apply an internal TNMM, and they will look at the return on sales earned by the free zone from a related party sale in the UAE mainland and from a third party customer in the UAE mainland as well. They could also do a comparison of the prices and margins between the sales of related parties in the UAE mainland and to the third party in the US. Yes, there would be certain adjustments around it. Working capital, what are my FOB or CIF trade contracts? Geographical differences, do I need to account for that? Inflation, etc. That is something which needs to be done, but yes, the authorities may also come back and challenge and compare the prices being sold to the third party. The key is to maintain the documentation determining the functional differences or the functional profile of the free zone entity, the mainland entities, and what value each and every entity is doing in the supply chain. Intercompany loans. You have a case where ABC UAE provides loan to a related party and earns interest. How will the authorities look at it, and what should be our benchmarking strategy? The credit rating of the borrower needs to be maintained, it needs to be prepared, either using Bloomberg, Moody's, Standard & Poor's benchmarking tools, something which we really need to do and ensure that the credit rating is available. The comparative loan agreements, after determining the credit rating, the comparative loan agreements or bonds need to be identified from databases which are typically Loan Connectors and Bloomberg's. Then a comparison of the term of loan, the purpose, whether it is a secured or an unsecured, all those need to be factored in when you are doing a benchmarking analysis for a loan being given by a business to its related party. And the arm's length range of that particular interest needs to be tested using the cup method. The tools which I've mentioned, the S&Ps, the Moody's, they're sometimes pretty expensive when we use them. Generally, a download or a search on that particular database is somewhere around $4,000 to $5,000 per search, which would really mean it really pushes up the engagement cost, the cost which an organization may not be willing to pay. Then there are certain financial tools available, Excel-based models which are available, which as professionals we can use to determine the credit rating and really help our clients to manage their compliances. Management cross charges. We've seen a lot of management cross charges. Nilesh in his example talked about a management cross charge being pushed down to all the group companies within that group. And typically, ABC UAE is providing certain services to its related party and receiving service payments. How do we do it? A detailed listing of those services needs to be maintained. If there is no intercompany agreement in place till now, we need to ensure that an intercompany agreement comes into place, because that is going to be the basis of what are the kind of services being rendered by the related party to its group companies. Shareholder cost needs to be excluded. So as a shareholder, I am obligated to look at few things: the MIS, the consolidations, right? All those costs which are being there cannot be cross-charged. OECD talks about it very specifically in Action Plan 8 to 10, and that is something which really needs to be excluded when you are doing a cross-charge for management charges. Backup of cost needs to be maintained. Salary slips, all direct and indirect cost needs to be maintained. There would be a whole amount of common cost. What is the allocation keys which you are using to cross-charge that amount to the group companies needs to be maintained. And the markup, either a 5, 7.5, 8, 10, the benchmarking of that markup is something which is there. Okay. Just quickly move. The benefit test analysis, is there a need to render those services, something which needs to be maintained and ensured to the authorities. You have a case, and this is the last case typically. You have a case, you are rendering two similar services to a third party and a related party. Then typically, you need to apply an internal TNMM. That is something which the authorities may apply, and that is where allocation methodology needs to be determined, and you need to have a transfer pricing PNL separately against the the third party PNL, because a transfer pricing adjustment will happen only on the transfer pricing PNL and not on your third party PNL. So what next? We need to identify related parties and connected persons, because the definition between in TP and IFRS is different. So we need to ensure that we capture every entity and related parties. We need to review and update our TP policies. We need to align them with our ESR filings, which we've already done in the past, so that there are no inconsistencies in place. We need to form tax group and determine TP applicability. If you are in a tax group, and Pratim possibly is going to talk about it, transfer pricing does not really apply when you are a part of a tax group. You need to update your IT systems so that all your payments to related parties are captured in your ERP. No transaction is left out. I'm sure authorities will come up with penalties in terms of misreporting of transactions, and hence we need to ensure that our IT systems are updated to capture all the related party transactions. We should start using the OECD templates. The master file and the local file already has a template in the OECD guidelines. So we just need to pick up those, start preparing, and so that at least at the fag end, we don't really rush ourselves in. And we need to then identify our benchmarking and requirements. How many benchmarks do we really need to do to comply with the transfer pricing requirements and do those benchmarks? Thank you.
Thank you very much. Thank you very much, Kapil, for simplifying these complex transfer pricing requirements. A big round of applause for Kapil Bhatnagar. Now I would like to invite our chairman, vice chairman and treasurer, C. Jayaprakash Agarwal to stage to felicitate Kapil Bhatnagar.
For the government, so they can spend more on the welfare. So I'm sure a lot of benefits will also come to us as the taxes gets into the market. And I must congratulate our chairman, Anurag ji, for selecting such an appropriate word, tax think tank today, which itself, kind of unite us to really go a little deep on various aspects. So such a great thought. Thank you so much, Chairman Saab. And to educate more on other topics, as our Secretary Saab just mentioned, we have two very learned speakers with us. So first, I'd like to introduce Mr. C.A. Joseph Philip, who is managing partner with Stott and Hamilton. He's a fellow member of ICAI and is an MBA with over 27 years of experience in audit, business consultancy, business risk, and accounting areas, and of course, tax. He has experience in wide range of industries, especially manufacturing, contracting, real estate, retail, and services. He is a guest faculty in various universities on finance-related courses or subjects. He was also a co-author of the book on VAT published by the ICAI when the VAT was introduced in 2018. And the second speaker we have is C.A. Neetu Jose, who is a partner with Stott and Hamilton. She has over 20 years of experience combined between UAE and India. She has a wide range of skills in accounting, auditing, financial advisory, and UAE VAT. She has worked in various industries such as retail, manufacturing, health and hospitality, and shipping. She has a proven track record of serving in various capacities for local and multinational companies in India and in the Middle East. So, without taking much time, please join me in welcoming our speakers, C.A. Joseph Philip and C.A. Neetu Jose, with a big round of applause, please.
Go with the IS 12. I would like to invite all the speakers and ExCom for a group photo.
Thank you, Rishi, for that fantastic introduction. And good afternoon to all. What a fantastic scene. Just like our CA time, that people still have the hunger to learn. It is very great to see. And we are starting with the IAS 12 today. So, 1 second. If we don't know something, that can be the great opportunity to do things on our own, right? What do you think that is correct? But if, what about IAS, accounting standards? That is true. If you don't know something, that is giving an opportunity to do things on your own? Of course not. Because accounting standard means we are not expected to do things differently. We are expected to do things on a uniform manner. That is why IASB has given this accounting standard to all. So IAS, we have learned how to calculate income tax, and from book account, additions, deletions, we all have learned, and arriving at our accounting tax profit. But how to do this into books of accounts? That is the main aspect, right? Booking into the books of accounts comes IAS. So IAS 12 talks about how to do the accounting, how to do the entries, what are the entries to be passed in the books of accounts. These are the main aspects we are learning in IAS 12. So Article 20 gives a detailed description of how accounting profit has to be found, then how accounting profit, from there what are the additions, what are the deletions to be done, and to arrive at the profit. But when it comes to IAS 12, they are showing it what are the entries to be passed as far as in the books of accounts. So what is the objective of IAS 12? IAS 12 gives prescribe the accounting treatment for income taxes, how to account for current and future tax consequences, and about the deferred tax assets. So instead of going to the definition, I am not going to the definition because it is a Sunday afternoon. If you go to the definition, of course, that is not a proper time for definitions. So I'm coming with an example. Suppose I am buying an asset. The value of the asset is, say, 60,000 dirhams. And the depreciation rate, what I am using, or the useful life of the asset is, say, 3 years. And suppose the tax people, they are saying that we can depreciate this particular asset in 1 year. And EBITDA for this company for the next 3 years from starting 500,000. I'm giving this example. This example will be used subsequently for all subsequent examples also. So please keep this example in mind. So assume that 9% means 3 years salvage value, and 500,000 is the EBITDA. And instead of 9% corporate tax, we know that the corporate tax is 9%, but instead of for 9%, I am adding up by 1% more. Oh, hope you will not object for that. The tax rate I'm taking it is 10% because for the ease of communication calculation, and also the standard deduction, I'm not considering the standard deduction. So from this valuation, you can see the asset value 60,000 as per books, and as per tax is also 60,000. And the depreciation as per books, it is 20,000, and tax people has given the option to depreciate everything in the first year, so depreciation as per tax is 60,000. So what is the carrying value? As per books, it is 40,000 because 60,000 is the value of the asset, and 20,000 is the depreciation because the useful life is 3 years, and so 20,000. So the carrying value is 40,000. So here comes, actually you know that now, there is a difference between the book value and the tax value, because the carrying value of the asset is 40,000 as per the books, and as per tax it is 0. So here comes, there is a difference, and deferred tax comes here, and the tax base comes here. So the tax base is what Neetu is going to explain now. What is the tax base?
Thank you, Philip. So here you can see, now we have the accounting base and tax base. Accounting base is nothing but that is the carrying value of an asset or liability as per the books of account. Excuse me. Tax base. Okay. Tax base. IAS 12 defines tax base of an asset as the amount that will be deductible for tax purposes against any taxable economic benefits that will flow to an entity when it recovers the carrying amount of the asset. One more is there, if those economic benefits will not be taxable, the tax base of the asset is equal to its carrying amount. So, let me explain this concept with a few examples so that it will be more clear for you. Let's take the example. A firm is having an accounts receivable of around 100,000. At the end of the year, they are going to provide a provision of 3,000. So, the financial reporting or in the balance sheet, the carrying value of the asset will be 100,000 minus 3,000, that will be 97,000. Whereas this provision is not allowed as a deduction as per the tax laws, and that will be allowable as a deduction when it is written off in the P&L or in the financials. In such a case, as per the tax rules, that asset value will be 100,000 itself, because the 3,000 is not allowed as a deduction at the time they are making the provision. So the tax base will be 100,000 in this case, whereas the carrying value as per the financials will be 100,000. In the next case, we can see the interest receivable. Here, the carrying value of the interest receivable as per the financials will be 100,000. Whereas, in the tax authorities will say this interest receivable will be taxable only on a receipt basis. In that case, the asset value of the interest receivable or the tax base will be 0, because that is taxable only on a receipt basis. The third case we can see here, dividend receivable. So the dividend receivable will be having an asset base in the financials of 100,000. The carrying value will be 100,000 in the financials, whereas IAS 12 state that if the economic benefit will not be taxable, the tax base of the asset will be equal to the carrying amount of the asset. So if the dividend receivable is not taxable, the tax base of that will be equal to the carrying value. So in this case, the carrying value as per the financials and as per the tax reporting will be 100,000. Moving on. The fourth scenario, in this scenario, the accounting base is nil, whereas we have a tax base. For a few examples are R&D cost. In R&D cost incurred can be deducted in the year if it is incurred. It will be deducted in the accounting report, the year in which it is incurred. But for the tax purposes, they may say you can deduct it only in the future period. In such a case, your accounting base will be 0, your carrying value will be 0, whereas you will be having a tax base. The same is the case with the carry forward of loss. Moving forward to tax base of tax base of liability. The tax base of a liability is its carrying amount less any amount that will be deductible for tax purposes with respect to that liability in future periods. It's an example. For example, if a firm has received a rent in advance of 5 million, it's for a period of 5 years, and the local tax authorities require 70% of the rent received in advance to be taxable. In this case, the financial side or the balance sheet will be showing a carrying value of 4 million, whereas what is the tax base for that will be 4 million minus 2.8 million. That is the 70% which is already taxed minus the difference, that is 1.2 million will be the tax base for the received any amount, any income received in advance. Okay, and there are certain expenses or the provisions which will be deductible only on a payment basis. In that case, the balance sheet or the financials will have a carrying value, whereas the tax base will be nil because that is taxable only on a payment basis. Hope this is clear now what is the tax base concept. Yes. So let's continue with the example. We'll continue.
All right, so now it is clear about the tax base. And now we are moving into deferred tax. Because this is the main concept actually in tax accounting. Because you know that the tax as per the books of accounts, the income as per the books of accounts will never match with your accounting income. So always there will be a difference between the books profit and the tax profit. So how the deferred tax, again, instead of going into the definition, I'm going back to the same example. So this is the example which I explained earlier. Asset purchased, 3 years is the useful life, and the tax authority says that, okay, you can write it off the asset in 1 year, and the profit is 500,000, earning before tax and depreciation is 500,000, and we are considering it as a 10%. So what will be the situation now? Because EBITDA is 500,000. I'm giving it as an example. Why? Because I think it will be easy for you to understand when it gives us an example rather than explaining or defining, giving the definitions of deferred tax and all. So 500,000 is the EBITDA, and 20,000, as you have seen, it is the depreciation as per books of account. So what is the earning before tax is 480,000. That is very clear, right? And what is the earning before tax as per income tax? It is 440,000 because the entire asset is allowed to depreciate in the first year itself. So the profit as per taxation computation is 440,000. So there is a difference. The tax at 10% if you compute, it is 480 as per books of accounts. But how much we have to pay tax? Do we have to pay 48,000 as tax, or we have to pay only 44,000? How much we have to pay? Yeah, we have to pay only 44,000, but how much is the actual profit we made? We made 48,000. Only thing is we are paying only 44,000. It is not that, okay, we don't have to pay. Only thing is actually we are deferring the payment to subsequent years. It is a timing difference, right? It is not that, okay, we made a profit of 480,000 means actually we are supposed to pay 48,000 to the authorities. The only thing is, instead of paying now, we are deferring it. That is the basic concept of deferred tax. So what is the deferred tax here? It is 4,000. And 4,000 we need to pay subsequently. So whether it is a deferred tax asset or a deferred tax liability, it is a deferred tax liability. And this 4,000 so what will be the entry? So in that case, actually, we have to pass some entries in the books of accounts, right? It is evident that we are paying 48, our profit what we earned is 48,000. So we have to pass in the books of accounts the current tax expenses 48,000. And what is the liability we have to put in our books of accounts? It is 44,000. And what is this liability? This 44,000, when we have to pay? We have to pay by 30th of September 2025, right? So this is a current liability. And what about 4,000? What is the nature of liability? It is a non-current liability, right? Because it is not what we are going to pay in 2025, but instead of that, we are going to pay in subsequent years. So this is something called deferred tax, and this is a non-current liability. So this entry is clear. This is the entry what we have to pass in the books of accounts. By current tax expenses, we have to pass an entry for 48,000. And income tax payable, which is 44,000, which is a current liability, which we are going to pay by September 2025, and deferred tax liability, which is 4,000. So what will be the situation in what will be the situation in second year, third year? This is the condition, right? The earning before tax is 500,000. And the tax, as you know, it is 3 years, writing it off in 3 years. And so again, 20,000 is the depreciation. But we have already availed 50,000 in the first year itself. So there is nothing we have to avail in as per taxation. So earning before tax is 480,000. And as for tax, what is the profit? What is the earning before tax? It is 500,000. So this 500,000 is as per tax, and as per books, it is 480,000. So the tax what we are computing, it is 48,000. How much actually to pay now to the tax authorities? What we have to pay is 50,000. So that 2,000 dirhams is the difference. Again, it is a deferred, instead of deferred tax liability, this is deferred tax asset, which we are going to adjust from the deferred tax liability of 4,000, which is already lying in the books in the non-current asset. So 2,000 we availed in the second year. And again, the same transaction which is going to happen in third year. Again, 2,000 dirhams we are adjusting against the deferred tax liability which we have created in year 1. And so deferred tax asset 2,000, 2,000. So these entries we have to pass in the books of accounts. And when passing these two entries, our 4,000 which we have already created as a non-current liability will be squared off by passing these two entries. So this is basically the concept of deferred tax asset. So now for just for a minute, can you just think the reverse thing? Because as per company policy, we are writing off the asset in 1 year, and the tax authorities has given the option to write it off. Means the tax authorities suggest it is 3 years. The useful life of this asset is 3 years. Then what will be the situation? The opposite, right? Instead of deferred tax liability, it will be deferred tax asset 4,000. Then year 2, it will be 2,000 dirhams deferred tax liability, and year 3, deferred tax liability again, and the 4,000 of first year. So these two things, the 4,000 will become, instead of deferred non-current asset, it will become non-current liability will become non-current asset. So the concept of deferred tax is clear, I believe. So there are, so what is the entry we have to pass in year 2 in this case? Because 48,000 is what the tax we have to pay, so we are debiting tax expenses, 48,000. And income tax payable, there is no doubt about that, it is 50,000, right? Because the actual profit, because we cannot take the benefit of income tax in the other example. So 50,000 is what we have to, so in the current liability, we have to show 50,000. And as a tax expense, because we have availed the depreciation benefit, so it is only 48,000. So the difference, deferred tax asset, which I mentioned, which we are adjusting against the deferred tax liability created. The same entry we have to pass in year 3 as well. So now these are the journal entries we have to pass in the books of accounts when taxation comes, which we have never done. So this is the basic things as far as deferred tax is concerned. So what is the concept of, this is called temporary difference, because this difference is not permanent, this is temporary, and this is a timing difference because we are adjusting this over future periods of time. And there is something called permanent difference, which Neetu will explain. Neetu, can you explain what is a permanent difference?
So, as you know, when you calculate the accounting profit and taxable profit, there will always be a difference. And one such difference will be it's a temporary difference, as Philip has explained. The other one case is permanent difference. Permanent differences are there, one-off differences, and these differences are not going to reverse in the future period or the subsequent period. This arises because there are certain expenses which are not deductible as per the tax laws, and there are certain income which are not taxable. So examples are there. So let's just see so we can see an example here. Company has a profit of before tax of 500,000. Included in the profit are traffic fines paid and the local dividend of 50,000. The tax rate is 10%. So the dividend income is exempt, and the traffic fines are not allowed as expenses. So your taxable profit will become 470,000, adding back all this, and your current tax, there will not be any temporary difference, and the current tax expense will be 10% of 470,000. There will not be any deferred tax expense, and the total tax expense will be 47,000. That's it, and this is how the financials will look like. So the non-current deferred tax asset will come under non-current assets, and deferred tax liabilities will be under non-current liabilities, and current income tax payable will come under the current liabilities, and the profit and loss account, it will be the tax expense, and if it relating to other comprehensive income, that part will come in the OCI. So that's it.
Hello. Yeah. So basically, we have just covered the basic concepts of IAS 12, and there are complicated areas like business combination affecting the amount of goodwill, and unused tax losses and unused tax credits, and all are there, which is the complicated aspects of IAS 12, because the constraints of time, we are limiting with the basic concepts only, and I think with this we have a minimum understanding of IAS 12 and the basic aspects. Thank you very much.
Thank you, Joseph and Neetu, for letting us know that IAS 12 is also equally important along with international accounting standards. Let us have a big round of applause for both the speakers. I would like to invite our chairman, vice chairman, and Rishi Chawla to felicitate both the speakers.
But before I felicitate, one thing that I wanted to say about, Joseph and Neetu, when I spoke to them about the topic, generally the hesitation is there when you come on the stage, when you can talk to such a, intelligent and progressive audience out there. It's very difficult. But the kind of job that they did altogether, they require a big round of applause, friends. Let us all be encouraged.
So tax group nitty-gritties were simplified by Nilesh Asar. Now You know, the tax group, like Nilesh said, and as per the law, it's allowed only with the resident person, a juridical person with 95% of indirect, direct holding, profit sharing, and ownership or asset, profits, liabilities, and all. And another condition was that, or is that, no one should be the exempt person or qualifying free zone person, and with the same financial year, same accounting year. Just because of new addition, new deletion, exit from the group, there are different provisions of the law which we need to understand, we need to make it simplify, and to make these complexities simple to us, today we have with us Pratim Sen Gupta, Associate Director Tax, Anderson in UAE. And to introduce Pratim, I would like to invite our Executive Committee member, Sri Malavika Kolera, to the stage. जाग रहे हो सारे? Thank you.
The UAE corporate tax provides for forming a tax group among taxable persons, subject to meeting necessary conditions. In addition to meeting the necessary shareholding and voting rights by a parent, it is also necessary that a consolidated financial statement be prepared and that all companies follow the same accounting standard. Therefore, data collection and processing becomes important and sometimes a challenge. To tell us more on tax group and challenges, we have with us CA Pratim Sengupta. He is an associate director who leads the direct tax practice at Anderson in UAE, serving a diverse client portfolio in the region. Pratim has close to 11 years of experience in providing solutions in all corporate and international taxation matters to a diverse client portfolio of large multinationals based out of India, USA, Japan, Spain, UAE, and Australia. Pratim has extensive experience in leading direct tax assignments involving compliance, advisory, structuring, litigation, and dispute assignments. Pratim has also presented and contributed on international and corporate tax matters and updates on external forums. He is a chartered accountant and a member of the ICAI. Pratim also holds a bachelor's degree in commerce from the Calcutta University. Please join me to welcome CA Pratim Sengupta.
First of all, I would like to thank ICAI for inviting me to speak at this lovely forum. Before I begin, just tax grouping, it's a buzzword, and everyone thinks that, if they have multiple organizations or companies within their group structure, right? Let's go in for tax grouping. It's something easy. Let's go for it without thinking, but it requires careful analysis. And I'll get to it. More than, before getting to some, practical aspects, I'll try to cover certain practical aspects and challenges during my presentation, and those finer points that may seem obvious at the time of reading the law, but it can get complicated in certain situations. Now, before I begin, who can tell me what are the conditions for forming a tax group? Can people tell me all the conditions? Some. What? Okay. Anything else apart from 95% interest? Okay. Is it just a free zone or there's something else? Okay. And anything else? Okay. Okay. First one. Only resident juridical persons can form a tax group. That means a foreign taxable person cannot form a tax group. That is a primary condition and the first condition. Then you move on. Yes. Then they'll be considered to be a resident person. There are exceptions to it. So if a foreign company has a POEM in UAE, they would be considered to be a resident and could possibly form a tax group. Second, you see the 95% condition. This is not only a ownership condition, but to have a right to the net assets and profit, and also the rights to the voting. Then you move ahead to the fact that you see whether all the companies, either of them are exempt or qualifying free zone entity. If there are any such entities, you cannot tax group. Cannot include them in the tax group. Fourth, all the entities have to follow the same financial year, rightly pointed out. And fifth, the parent and all the subsidiaries have to prepare their financial statements using the same accounting standards. That means accounting standards cannot differ. And this is important, I'll get to it. Now, just one simple example, you have a UAE parent holding a mainland entity. This has a branch. Would the branch be considered a separate taxable person? No. Okay. It has another UAE mainland entity. It holds 94% of the legal ownership of this entity, and another one qualifying free zone entity, 100%. Which are the entities that can form a tax group here? Only the ones there? That's correct. Simple. Before I get, what are the advantages of forming a tax group? Can people tell me? Wait. No TP compliance. Okay, one. Okay. You can offset losses, yes. Yeah. That is yet to come out. We'll have to find that out. Interest limitation. Anything else? True, it leads to less admin work. So a tax group will be considered to be a single taxable person. That means, like people have highlighted, tax administration would be done at a single level. Return, even registration would be single. That's how the law reads. And I know practically a lot of people have got emails, right, from FTA that please register. I would advise them at least look at whether you're forming a tax group or not and then make an informed decision on it. Don't just go ahead and start registering from now. And like everyone, so there's been netting off of intercompany transaction. Regarding the TP, I'll get to it. There seems to be an exemption, but let's read it in a finer manner. And of course, the parent, when he's filing the tax return, has to consolidate the financial results and the asset and liabilities and file the tax return. That indicates that the parent has to prepare a consolidated financial statement. Now, forming a tax group is not automatic. You have to file various applications and get approval. Even joining a tax group, a subsidiary joining, or a parent replacing itself has been provided in the law. It's all done through application. I'm not going to spend much time because there's paucity of time right now, but I'll go ahead to the practical aspects. Now you have a foreign company holding two mainland entities. Now you have a foreign company holding a UAE holdco and the two mainland entities. Can I form a tax group in both the scenarios? Only in the second case. Why not the first case? Exactly. So if the FCO had a poem, then a complication could come that you could form a tax group, but that has to be analyzed factually. This also holds true if I replace FCO with just an individual shareholder. Then the complication again arises that if that individual shareholder is not covered under corporate tax law, right, is not a taxable person, then a holdco may have to be formed again. This is a practical challenge and something that people need to look at while looking at the group structuring. Now let's look at this example. You have a UAE holdco holding a UAE intermediary holdco, a mainland AB, the intermediary holding C and D. Can the UAE entity holdco form a tax group with all the entities? It can? Yeah. Can UAE intermediary holdco form a tax group? It can? Yes, because it satisfies all the conditions. In the law, there is no restriction that within an organization, you can restrict the number of tax groups that you can form. It appears that you can form multi-groups. The intermediary holdco also satisfies all the conditions, assuming all the financial year, the accounting standards, all those conditions are satisfied. Because it holds more than 95% of C and D, it can also form a tax group, and there can potentially be 2 tax groups in this organization structure. Sometimes this may be required when large groups want to segregate the tax groups within different business lines and may want to consolidate each business line separately. This is done even internationally from time to time to have separate reporting and separate visibility on each business. Now this is an example that has already been covered about the first speaker, Nilesh, had covered this regarding legal ownership and beneficial ownership. We have to look at the law, whether legal owner, whether you have to only look at legal ownership, voting rights, but it appears so. Beneficial ownership, whenever internationally any statute has been enacted, and whenever a statute wanted to give benefits to a beneficial owner, they have used the word beneficial ownership. This law does not have the word beneficial. So it appears that you have to only look at legal ownership. Regarding financial statements, right, I'll get to this. Now the first point that I mentioned was each company within the tax group has to firstly follow the same financial year, and the parent and subsidiaries have to prepare the financial statements using the same accounting standards. That means even though you are preparing a consolidated tax return, there seems to be an obligation for each entity to prepare the standalone financial statement. This does not mean that if you just form a tax group, you only prepare a consolidated financials at a UAE parent level. Remember, one of the conditions is that parent and subsidiary must maintain financial statements using the same accounting standards. So while there might be less administrative hassle from a tax return point of view, from financial statements, it seems that every entity needs to prepare a separate standalone financial statements. Now coming to transfer pricing. The FAQs had, after the public consultation document, the FAQs had clarified that if you form a tax group, TP will not apply. The law is silent on it. The law, you can only deduce this from the law. You can say that the law says, you need to set off or net off all the intercompany transactions. If you net it off, you net off all the profit and losses. So why do TP? You're interpreting something. It's not been explicitly provided in the law that this is exempt if you form a tax group. Wait for regulations. It might be exempt, but acting upon that, right now, there's nothing in the statute.
You have to wait and watch. It's likely to be exempt, but we have to see. There's nothing in the law. And just acting upon FAQs, it's not recommended. You should wait for some regulations or the law to speak about it. Now coming to thresholds, right? When I said single taxable person, that means a threshold will also be looked at in a singular manner. That means a threshold of 375,000 will be looked at the consolidated level. Now, if you have, say, 5, 6 entities, right? And some are profit making, some are loss making. You could have had this threshold at each company level, but now it will be only at the consolidated level. This needs careful analysis, and you need to do detailed working to see whether forming the tax group will be beneficial or not, given the profitability of each entity. Now let's look at some numbers here. Say in case 1, right? You have 2 mainland entities making 350,000, 350,000. And the whole co has a loss of 150,000. If you did not tax group, 350,000, 350,000 falls below 375. No tax. 150 loss you could have carried forward. But if you form a tax group, right? 350, 350, 700 minus 150, you come to a taxable income of 550, which is above 375. You have to pay tax on 175. Second case, 400 each, 150 loss. As a group, you have made a profit of 275 on which you have to pay tax. Here the loss, what we have done is still, it's not a fixed position. The law for losses actually reads is, departing from tax grouping, reads that tax losses or part thereof can be transferred. So we have only transferred a part of the losses that are available with the whole co. We've given 25, 25. 375, we bought it to the level of the threshold, no tax. There you carry forward 100. Coming to tax group and losses unutilized. So how this loss works, say you are already a tax group, right? You acquire a subsidiary which has existing losses. This subsidiary is made part of this tax group, but the law is not very progressive here. It has some anti-abuse provisions built into tax grouping provisions. They say that this old losses of the subsidiary cannot be utilized to set off the income of the tax group. Only it can be utilized to set off that portion of the tax group's income that pertains to the subsidiary after joining the tax group. I know I've said something very complicated. I'll get to an example, but basically they're saying any old losses you have for the subsidiary can only be set off against the future income of the subsidiary even after the subsidiary comes into the tax group. Similarly, if the new subsidiary had profits and the tax group has old losses, those old losses cannot be utilized against the subsidiary's profits after joining the tax group. And loss cessation. Say the tax group cedes. It stops because the parent doesn't meet the conditions anymore, or the parent is there no more. It's become a defunct company. What happens to those losses? If the parent still continues, all the tax group losses remain with the parent. If the parent is no more, none of those losses which were incurred while they were tax group is available. Only those losses which are available to all the subsidiaries prior to joining the tax group is now available in the future. Say as an illustration, a subsidiary has a loss of 300 in year 1 and the existing tax group's income is 200. Year 2, the subsidiary is taken over by this tax group, this group, made part of the tax group and joins. Subsidiary has an income of 300 and the remaining entities in the tax group have an income of 400. Now, when I'm trying to set off the losses of subsidiary, say I have the old losses of subsidiary and my current income is 400 and I have a limitation of 75%. Do I apply 75% on the 300, the income of the subsidiary in year 2, or do I apply 75% on 400? We don't know. There is no conclusion on this. And I may not be able to give you an answer here. Law is very vague here. Yes. Usually, any consultant will tell you, and however tax laws have evolved in other countries, a taxpayer will always interpret the law which is beneficial to them. Then the tax authorities will interpret the law which is beneficial to them. So we'll have to see this. Yeah. Case 2, 150, 200. Year 2, you have an income of 100 and a loss of 150. Tax group has a net loss of 50. Subsidiary, so there's an old tax loss of the tax group, but that because there's a net loss, it may not be possible to set off any of those old losses, and especially when the income pertains to the subsidiary. Coming to case 3, now in year 2, you have an income of 100 from the subsidiary and the remaining entities have a loss of 50. Year 2, income, now you have 50. Now you're looking at your losses, right? You see that your existing group has old losses of 200. But there is a restriction here. Because it's an old loss of the group and the subsidiary has joined newly, and the income for the tax group pertains to the subsidiary, you may not be able to set off the old losses of the group. And you'll have to pay taxes on that 50 and can carry forward 200 from the previous year. I think, do I have 5 more minutes? Yeah. So this is another example of grouping and losses. There's a UAE holdco which has a profit of 500 million. It holds another UAE mainland entity of 200 million. It made a taxable profit 200 million. And entity 3 made a profit of 100 million. You have a mainland entity 1 which is outside the tax group, where there's only 75% shareholding. It has a loss of 650 million. Can you transfer the losses to the tax group? Yeah, you can. Because transfer of tax losses is between taxable person to taxable person. The tax group will be looked at as a single taxable person. What extent can you transfer? 500, 200, 100. %75% of 800. Exactly. Only 600 can be set off. With this, I end my presentation. I thank you all for taking your time and listening. Any queries after this, you can reach out to me.
Thank you, Pratim. To make those complexities simple for all of us, a big round of applause for our speaker, CA Pratim Sen Gupta. I would like to invite our chairman, vice chairman, and CA Malvika to present a memento, and would like to invite our past chairman, CA Naveen Sharma ji. Do you know what is the essence of the law? Something called preface, and in that it's called essence. An essence of the law is, it's defined in Article 11, Chapter 4, the residency rules. Taxable person. One should be either resident and non-resident. So how a non-resident can be taxed in the UAE? Now Chairman Sahab has said that, read that law again and again. So by creating a P, a non-resident can become taxable. Or if he falls, like certain conditions are there. The third one, I don't think so anyone has clarity, nexus of compliance or tax in UAE. So who will define this nexus? The cabinet minister. So to share the importance of residency rules, today we have with us our own CA Manu Pallarichal, CEO and founding partner, Emirates Chartered Accountant Group. And to introduce CA Manu, I would like to invite our executive committee member, C. Amit Khetan, to the stage, please. Thank you.
Good evening, members, and thank you, Honorable Secretary Saab, CA Manoj Agrawal ji, for giving me the opportunity. And I've been assigned the task to, to introduce our next eminent speaker. But actually, he doesn't need any introduction because you often see him on the radio talks channels, various social media platforms and TV channels. And he has been like conducting so many seminars and used to speak the UAE compliances and most recently about the UAE corporate tax. So still let me read out his formal introduction. CA Manu Pallarichal is a chartered accountant and certified management accountant, started his career in Dubai 2003. He is passionate professional with methodological approach, possesses more than 20 years of extensive experience in the field of finance, accounts, audit, taxation, and management consultancy. And he is well versed with the practical experience of implementing VAT in the UAE, Bahrain, and Oman. He is also conduct trainings on regular basis and has already conducted more than 250. He just updated me, is more than 350 VAT seminars and training sessions across the UAE, Bahrain, Oman since May 2017. CA Manu currently holds the following honorary positions. He is the Vice Chairman at International Chamber of Commerce, UAE Custom and Trade Facilitation Commission. He is Board Member, Asia Pacific Representative and Tax Committee Member at ICAI Paris and International Association of Auditors, Account and Tax Professionals. And he is the Board Member, Association of International Tax Consultants. And moreover, he was my colleague in the managing committee last year and good friend of mine. So please put your hands together for CA Manu.
Good evening, everyone. Now, we are a little late, so I'll straight away start the subject. My responsibility is to discuss on residential status in the UAE. So today the speakers covered many parts of corporate tax, but for me there's only one provision or article in the law to speak about. So what I'm going to do is really connecting the dots between Cabinet Decision number 85, which was released in September 2022, and corporate tax and the tax treaties UAE signed with the different countries. So the part one, always we are confused whether you are a tax resident here. Even just now, Manoj, our secretary, was discussing a company who will be a non-resident. Whether a company registered outside can be considered as a taxable person or it's a resident or non-resident. So different aspects are there, that's what we are going to discuss. Everybody is confused. Whoever reads the law in first attempt, who's really a non-resident? If all the companies registered outside UAE is resident or non-resident, we'll come to that point. I'm going to discuss what is tax residency, relevance of tax residency, the fundamental approach to determine the tax residency, and who makes this tax residency complicated. Second part, should I show in this direction? Basics for determining tax residency, all these three areas, cabinet decision as well as tax treaties. Then our latest corporate tax law, and then this tax treaty versus the domestic law. These are the area what I am going to cover today. Why the tax residency is relevant? To determine whether we are taxable in that specific country or not. So as an individual or as a legal entity, whether it's or he or she is liable to tax in that specific country. So when we determine the location or the jurisdiction, then it creates confusion because the people travel across or the company will be managed from different countries. So it varies. The determination of tax residency is little complicated in many cases. That's what we are going to identify today. This is the direction I have to show. Or that. This. Purpose of determining tax residency. Determine the eligibility of tax treaty, because as per the tax treaty, only the resident of such country will be eligible for getting the benefit. To determine whether world income would be taxed in that particular jurisdiction, accurately report the tax income in the right country, and last, apply the tax residency certificate for that benefit. Third point, the fundamental approach, everybody knows. Since we are coming from India, that 183 magic number is always everybody is aware of it. Country where the person resides or country where individual spends more than 183 days is the general approach to consider the tax residency. In the case of entities, it will be country where it is incorporated. That is a basic fundamental approach. Now, the digital nomads created the complicated world for tax residency. That is the complicated area, whether it is entity or as an individual. After COVID-19, even there are studies says, even more than 50%, even up to 100% of the increase in work from home, or even people work from different countries. So this digitalization made this cross-border tax complications more worse. So we are also experiencing, even some cases people ask me, when people go for vacation in their home country, if they work from home, that vacation extends for 1 month, 2 months, 3 months like that. Is there any issue tax related? Of course there is an issue. P may get shifted to that country. So we'll discuss in detail when going through the other areas. So P exposure and then cross-border, people move from one country to another and then work from there, or even the managers or the manager decision will be taken from different places. All this makes the complication. So that's what we are going to identify based on the latest cabinet decision, that is cabinet decision number 85 of 2022. Let us understand how the tax residency has to be determined in the UAE. Conditions for a legal entity to be considered as a tax resident in the UAE is, if, number one, if it is incorporated, formed, or recognized in accordance with the local legislation, or the tax resident in accordance with the tax law. This decision came in September 2022. There itself it is mentioned that if the company is registered in the UAE, it's a tax resident in the UAE. But if anything extra is mentioned, any other provision is given in the upcoming tax law, that also will be considered as a resident. So in the Article 11, there is a provision included, place of effective management of a foreign entity. If it is POM, that is place of effective management is in the UAE, that also will be a resident in the UAE. This is very important, branch of a foreign foreign entity will not be a resident in the UAE. That's very important to be considered here. Going forward, UAE tax resident Article 4, natural persons. One second. Yeah. As per this provision, as per this cabinet decision, Article 4 says, a natural person will be tax resident in the UAE if the following conditions are mentioned. First point, let us see it. Usual or primary place of residence and the center of financial and personal interests are in the UAE. That means anyone who's having primary place of residence in the UAE and center of financial and personal interests are in the UAE will be considered as a resident in the UAE. You can think it from the UAE nationals angle. The number of days criteria is not mentioned there. Second one, physically, if one person is physically present in the UAE for more than 183 days, not more than means 183 days or more within 12 consecutive months, then also he will be considered as a resident in the UAE. The third point, very interesting, UAE national, GCC national, or people like us who are UAE resident permit holder. Physically present in the UAE for 90 days or more in a period of 12 months and meet these conditions, any one of the conditions, that is, has a permanent place of residence in the UAE or carries an employment or business in the UAE. If we stay here 90 days and holds residence permit, then if we have a permanent place of residence or we are employed or we have a business in the UAE, we will be a resident in the UAE. Just 90 days. People do not have the resident permit, that means a visa or permanent visa or the resident visa in the UAE. If they have to be considered as resident in the UAE, the number of days has to be looked into. I'll explain this with an example. I'm looking into two angles, outbound scenario and inbound scenario. Outbound scenario is for normally, that is the UAE nationals, for them to satisfy as to be considered as a UAE resident. Number one, if they are staying, if the individual resides outside the UAE, but if he has primary place of residence in the UAE and center of vital interest, that is a financial and then personal interest here, then he will be considered as a resident in the UAE. Otherwise, if he is residing in the UAE for more than 90 days and has a permanent place of residence in the UAE or carries a business, that's what the second clause I was mentioning. So in this case, normally people move outside will be, if they are having a primary residence in the UAE, they will be considered as a resident in the UAE. The second point will be more interesting. So before that, very interesting, very important, we have to look into the treaty and in some cases, possibility of dual residency. In that case, we have to look into the treaty and get the benefit, and we have to decide in which country he is a resident. I'll go through that one in the next slides, upcoming slides. This will be more interesting for people like us. If an expatriate resides in the UAE, will be considered as a tax resident in the UAE if residing in the UAE for more than 90 days. If we have permanent place of residence or carries a business or an employment. Here, interesting, again, the number of days we have to look into. What I'm going to discuss next is, I'll go through the tax residency under corporate tax. Then I will come to the tax treaties. Then we will understand how to handle it. I'll explain that one. As a second part, I'll be going through the tax residency under UAE corporate tax law, residents and non-residents under UAE corporate tax law. Mainly, it has to be the people or the entities or individuals are divided into two under the corporate tax, that is taxable person and exempt person. Taxable persons are two types, that is resident and non-resident. Resident, who are residents? Entities or the juridical persons incorporated in the UAE and branch are resident. Foreign entities which are managed and controlled in the UAE, from the UAE also resident in the UAE, and natural persons who are doing business in the UAE. That will be certain conditions will be this, or the categories of activities will be mentioned or will be released through the cabinet decision, which are the activities will be considered as a person doing business in the UAE. So these are the three categories of entities or individuals. That is one, company registered in the UAE. Second one, company registered outside. POEM is here. And third one is POEM means place of effective management. And third one is natural person who are conducting business in the UAE, whether he is a UAE resident or non-resident. If he is conducting business in the UAE, still he will be considered as a resident for the tax purpose. Non-resident, permanent establishment, a detailed subject. I'm not going in detail on what is permanent establishment, but just for simple, everybody understands it, everybody knows it since everybody gone through the law. But as an example, if a foreign entity is having a branch or place of management, office, factory, warehouse in the UAE, it will be considered as a fixed place of establishment. There are 4 types of P's. Fixed place of establishment. Number 2, agency P. Number 3, the construction P. Number 4, the service P. The first 3 are mentioned already covered in the corporate tax law. But the fourth one, the service P, is not mentioned in the law, but an interesting word is mentioned, nexus. Let us wait and see what is the outcome of it. So, if P is there in the UAE, income earned from that P, whether in the UAE or income connected with that P, even though outside UAE, will be taxable in the UAE. Second one, UAE source income will be taxable in the UAE, even though there is no PE. And nexus, let us wait for the details in the upcoming cabinet decisions. This is the segregation, residents and non-residents. Just going forward, applicable tax rate, though it is not very relevant of my residency subject. Mainland and free zone, juridical person are divided into mainland and free zone. For the mainland, it is 9%. Free zone, of course, qualifying and non-qualifying income will be divided into 2, and then 9% and 0%. Then the other rates. So here, UAE source income, probably it will be the withholding tax, currently 0%. In some cases, it may be 9% also, depends upon the activity. So we have to look into that. So this is the scenario in corporate tax which is relevant to be considered while discussing from the residency angle. Just an example, extending this one, just UAE taxable region, this part, juridical persons incorporated in the UAE and its branches, of course, taxable in the UAE. If a company is registered outside UAE, but POEM is in the UAE, it is coming as a taxable person in the UAE. Third one, company, a foreign juridical person, but PE or state source income or has a nexus in the UAE, then that also will be taxable as a resident person, taxable in the UAE. So this is the picture I want to give from the corporate tax angle on the residency. Now, very interesting, the residency concept under tax treaty. As per Article 4 of OECD Model Tax Treaty, the tax residency is determined considering the provisions of the tax treaty in that respective country. Clause number 1 in OECD model, Article 4, Clause 1 defines the criteria to determine the tax residency. Second one, if there is a tiebreaker rule, if there is a tiebreaker requirement, then the rule for tiebreaker for individual, and clause 3 says on the legal entity how to have this apply the tiebreaker rule. With some example, it will be easy. We can't read all the 130 tax treaties UAE agreed or signed with other countries. One of the major countries UAE didn't sign with another country, so that is US. So far not signed. We are waiting for that one. Once that also signed, there will be a big change in this tax practicing area or the advisory area. There will be a lot of opportunities. Let us learn UAE tax treaty. First one is UK. In the case of natural person, in UK, from the UK's angle, in the UAE UK tax treaty, double tax avoidance agreement, in the UK it is mentioned liable to tax in the UK under the tax laws in the UK, but at the same time UAE has got this point, a domicile, habitual abode or center of vital interest in the UAE under the law of the UAE. So when you go through the other provision, other treaties, you can see the difference. In the case of India, India's resident as per Indian law, but in the case of UAE, not 90 days, it is 183 days. In the case of KSA, it is as per the local law in both cases. So for an Indian, 183 days is important. At the same time for KSA, 90 days is enough. And see the last one, very interesting, Georgia. In UAE, to be considered a Georgian, a person who is coming from Georgia, even though he stays 90 or 180 days, it is not sufficient. Has to be a nationals as per the UAE law. Only a national will be considered as a resident in the UAE, so it varies. So in the case of legal entity also, the treatment is different. How much time I have got? 10 minutes, thank you. So legal entity, in this example you can see in each treaty, the clause is different. So we have to look into each treaty to take a decision whether a person, legal entity or an individual is a resident or non-resident, resident in that particular country or not. This is very interesting area, how to break the tie. Suppose a person is resident in both countries. As per the law, so the check has to be, tiebreaker rule has to be applied like this. Check whether where he has got a permanent home. Suppose a person has got a permanent home in both countries. For example, maybe we are having a permanent house here and then in India also. Permanent house doesn't mean that it has to be owned by us, even that rented apartment also will be considered. Then check what is the center of vital interest, personal and economic relationship more in which country. If you are not able to break that one because we are very much socialized here and financially we are managing everything, all the interest is here. So, and in India also. So see that case, in that case, still you are not able to solve this tie. break this tie, then look into habitual abode, how frequently you are traveling, where you are traveling, or how your stay and then connectivity. Look into next, even though you are not able to solve it, go to the next nationality. Even with that, if you are not able to solve it, leave it to the authority. Let mutual agreement procedure decide. So this is the step we have to take, and in the case of entities, or in the legal entities, you know that a poem, people think that just board meeting is enough to take a decision. Suppose we have a Cayman Island company, and there are a lot of holding companies which are registered in Cayman Island or other BVI and managing from here. Just going anywhere to do, I don't know how to reach out to Cayman Island. But if you are going somewhere in the other country and doing the board meeting, only will not shift to the PE. Anyway, the other, all those matters have to be looked into. If you are sitting here and taking all the board meeting, earlier I think Nilesh has gave a brief about it, so I don't want to go in detail. So not only the board meetings, all other areas into real activity where the real decision making is happening, real activity is managed, all these points are to be looked into, accounting records and legal status, and all the points has to be looked into to decide whether it's where the poem is, where the place of effective management. Based on that only we can decide about the residency status. 2-3 more slides only. Tax treaty versus domestic tax law. See, in treaty we have seen where, these are the 3 points I would like to highlight here. In treaty we have seen where only citizens of a UAE are considered as resident in the case of Georgia. Where the tax treaty relies on local laws to determine residency, that is in KSA, where the residency is based on number of days stay in India. See, it varies, and at the same time, that what domestic law says, all residents, irrespective of their nationality, is resident. Number of days stay criteria varies depending on the nationality in certain cases. Other criteria in the local laws mentioned earlier, so it will be mentioned as per the local law. So these are the areas where different clauses are there, where we have to apply it properly. Now you see, in just an illustrative example, 4 countries I am mentioning here, Canada, Mexico, Albania, and Georgia, where they, as per tax treaty, residency in the UAE based on the nationality. At the same time, based on the number of days, 183 days, India, Israel, Ireland, Argentina. Let us sit and go through more than 130 treaties and then understand how it is. Now how this tax becomes complicated. A person coming from doing business in Turkey, living in Turkey, no issue. He is resident there and then taxable there only. He came for an expo event, interested in Dubai. He stayed here for months, then participated, then he came as a tourist and then interested to do business. Extended that one, he set up a business in the UAE and that rendered service to KSA. Then again, he is suffering the withholding tax in the KSA. And moved family to UAE, worked in Turkish company in its UAE subsidiary, and KSA, Oman, all came into picture. And that's how people do the business, and then we have to advise them properly how to determine the tax residency. This is my last slide, so I hope I managed the time. So if anything, we can discuss now. Thank you so much. Otherwise, I'll be available in this number or email. Thank you so much.
Thank you very much, Manu. You made that residency rule very simple for all of us. Let us have a background applause for CA Manu. Now I would like to invite our chairman, vice chairman, and C. Amit Khetan to felicitate CA Manu, along with our past chairman, C. Anish Mehta, at the stage, please. So we have last session of today's. So in earlier sessions, we have discussed on the aspects of tax grouping, transfer pricing, residency rules, and another key fundamental of the tax law is calculation of taxable income. Chapter 6, Article 20 defines general rules of determining taxable income and calculation of corporate tax payable as per Article 44. To share the insights on tax calculation, today we have with us CA Komal God, Manager Taxation, UHY James, and to introduce Komal, I would like to invite our Executive Committee member, CA Sanjay Gagrani, to the stage, please.
Thank you, Secretary Saab. Winning is not a one-time act. It's a habit. Once again, I will congratulate each and every one for supporting us, supporting the vision of the chairman for getting an award. Thank you very much. Good evening, members, distinguished guests, and speakers. After so much of gyan, wisdom, knowledge, what ultimately matters for all of us? In taxation, payments, right? Rokda. To give us the insight on the tax payment, how to calculate the taxation, we have very young chartered accountant who came to UAE in 2017 when the VAT was introducing and taking the shape here. But his hunger about taxation was not getting satisfied and he's about to leave the UAE. But suddenly then, what happened? Corporate tax was announced. And that's where he decided to stay back. So Komal is a very young, dynamic, experienced tax and compliance professional for having more than 10 years of experience in the taxation, covering corporate tax and VAT. He's having an extensive knowledge in the regulatory compliance like ESR, UBO, etc. He's played a very vital role, also had a head of taxation and costing, and very big business house in India. So, ladies and gentlemen, members, please give a big round of applause to CA Komal.
Thank you. Good evening, everyone. I know how this last session works, or, every day, when we look at the office of last 15 minutes. But still, I would like to say, today I'll be the aggregator of the whole session of the speakers. When you look at, Mr. Kapil sir has given a transfer pricing input. When it comes to Preetham has given input on the tax grouping, and Manu has really covered on the tax resident. So now after, these are all strings that are really, hanging now. Now I'll try to join all these together so that, we will have how this tax computation exactly works. When you look at the Joseph sir also, he really added the deferred tax thing a one step ahead, after the computation. So now I'll take you through a little on this. See, when it comes to an accounting income and, whatever is the accounting income that we are following in the financial statements, it might be as per the IFRS standards, which is very much prevalent. But if you look at the law, it says as per the accounting standards, accepted accounting standard. So far, ideally, I believe IFRS would be the acceptable accounting standard. So once we are arriving at the accounting profit, whatever are the exempt incomes that are actually included in the P&L, because we tend to prepare a consolidated financial statements, which includes everything. So after considering the exempt incomes, we also might have some, special business restructuring reliefs, which have to be excluded. And the deductions, when it comes to our deductions, already covered by earlier speakers, list of deductions that have permanent difference when compared to our P&L. So these differences have to be excluded in order to compute the taxable profit. So, and also if you look at the transfer pricing adjustments, when all the payments made to the related parties or the connected persons, so it should be at arm's length. What if it is not at arm's length? If it is not at arm's length, we have to make respective adjustment here. And the beauty of the law is it is also allowing the counter adjustment in the other books of accounts so that the impact is nullified. So if you look at any incentives, in the GCC framework, only the Bahrain is left out if you look at the corporate tax implementation. So every country has come up with a special incentives as per the industry sectors, or or the motto of the countries. Like it might be a manufacturing incentive, or it might be a local incentive. Like considering if you look at the KSA, what it says is like even though the law has been implemented, for locals there's something called zakat, and then when it comes to a foreign resident, it is the corporate tax. So far as UAE has not come up with any specific incentives, like, we also have to look out for the further cabinet decisions which are going to roll out. See, since it's been already 60 plus days, the law has been out in the public domain, even though it is like October is the official date. But yeah, it has come into public domain in December 9th. So far what we were doing is like, we were trying to look like what best we can do into this. So one thing during this computation or every transaction advisory that we are rolling out through is, the GAR, like, which will be running always on our mind. Like, there is a thin line between, the tax planning and the tax evasion. So how we are breaking this thin line so that, in order to add value to our clients. So in case of incentives or tax relatives or any other specific, we just have to look out for the law. So further cabinet decision. So what we are hearing in the market is, since this is the first time the tax incidents in the UAE, we might not be having the full law handy. The law will be rolled out over the period of time. It might be in the form of notifications and circulars. See, whenever the tax incidents comes in any country, like, it will be like, we'll try to find out the revenue leakages, then the authorities will be looking at, how to close that revenue leakages. So one thing I can say, like, the way in which authority has progressed when it comes to VAT, or also initially they have given the law and then they have come up with the notifications. Recently also they have changed something in the tax procedures. So in the same way, even in the corporate tax also, authority might also slowly roll out on notifications and circulars on a real-time basis, having an effective date. So when I see this 5,000 plus chartered accountants who are having practicing here, somewhere back in your mind someday we might have had that, we are not doing a tax practice in a full-fledged way. But now I think next few years would be a ride where, we just have to go back and see, check with our friends and colleagues, like, what exactly is the change? Is it getting impacted? In the case of consulting profession, we should keep like every of our client or, to real time get updated if any notifications or circulars getting rolled out. So getting up to the tax loss relief, like, since the tax group conditions are stringent and considering the structures in the UAE where, these shareholders might be having a parallel ownership. So all of a sudden, if someone have to, restructure the whole business in the form of a tax grouping is little challenging thing. But however, if you see this, one of the benefits which can be formed part of the tax group has been given in the form of the relief. So if you look at the tax loss relief, if we have a common ownership up to 75%, still we will be able to set off the loss. Then again, the portal, like, the filing portal will be taking care of this domain, where we might be able to pick the TIN number where we have common ownership and we'll be adjusting in the computation. So after adjusting this, still if we have any taxable income over and above the threshold of 375,000, we'll be paying the 9% corporate tax. So if you see the 9%, as of now in the law, it says like if you have 375,000 above, it will be subject to 9%. But let's take an example, if you have 1 million. So it is on 1 million, either we are paying 9% or it is on the 625,000 that we're gonna pay 9%, we just have to look out. So since, if you see the UAE, they have in 2022, they have started like, January, they've announced they're gonna come up with a federal, like, corporate taxation. As per the information available in the public domain, UAE has 110 tax treaty agreements. In the 2022 itself, around 6 to 7 tax treaty agreements have been signed. That shows the pace in which the authorities are trying to move and trying to collaborate. Yes, however, there might be a future litigations in considering the tax zone perspective or a free zone perspective. So if we have any withholding tax or foreign tax credit, that can be adjusted straight, and whatever is the tax which is payable is coming, we have to pay within the timelines that has been given by the authority. So when I say the computation, the timeline for this computation is the time we close our audits, because without provision of tax, our auditors are not going to close. However, considering the cash flow or the compliance benefit, we can still wait for 9 months, but yes, we have to do at the time of closing our audit itself, our TP computation has to be closed. So moving ahead, I think like the speakers have already elaborately covered and, have tried to add real value on what exactly would be, the exempt income. But still, what I say is, as I started with, I am the aggregator for the session. So I'll try to quickly brush up the thing so that, it's a kind of revision in a way. So if we look at the predominantly the exempt income, what it covers is a dividend or a capital gain or other profit distribution. It is very clear that any dividend from the juridical person is an appropriation out of the profit. So in a straight case, it would be an exempt. But yes, in the case of the capital gain on shares or capital gain on the foreign sale or a dividend from a foreign juridical person, it clearly says the participation condition have to be there. Actually, the participation exemptive condition, like mostly like these are the major conditions where we say like, it's a 5% and the 12 months intent to hold. And then, the corporate tax rate should not be lower than the 9%. So one of the biggest thing is, being UAE being a headquarter for many businesses so far. Now it's an high time, like, when the corporate tax has come, like it's a tax on the worldwide income. So in which the Cayman Island, British Virgin Island, all this, tax haven income which was coming to UAE is at stake now. So many stakeholders are get worried, like if it is an individual holding in this islands, yes, again that is subject to an exemption unless until authority comes up with a different purview in the later cabinet decision. So as of now, it looks like a legal entity having any income from the tax havens, yes, it is falling under the domain of the UAE taxation. So when it comes to a foreign PE where, I have to draw a little light, where it says it can take two routes. One is an exemption route, or else one is a route through which we will declare and takes the tax credits. So everyone have to do their math when it comes to a foreign tax credit, because we are coming with a lease rate of 9%. If you just look at the, the information, hardly I see 1 or 2 countries having less rate of 7.5% and 8%. So predominantly what route is beneficial in this, foreign PE related thing, we just have to look at. Moving ahead, yes, when it comes to an expenses, so far we were talking about revenue. And it is also equally important that, what expenses are allowed for the deduction. So in general, in any law, it lies, they says like it should be related to the business. So it should be wholly incurred for the purpose of the business. So how you will be proving it for the purpose of the tax business is on us. So let's take an example like, if you see, I'm investing in one company, like, I want to invest in KSA. Let's suppose that's a hot market. So if I am doing a feasibility study and if I am doing some, R&D or setup cost, will that be allowed? Because that is, as of now, is not my taxable business. So the law is little silent on this preliminary expenses, like, on the setup basis. Yes, we just have to wait out and watch. However, if there are some expenses which are, equally related to the direct and indirect, like taxable and exempt income. I'll give you one example in that case. Let's suppose there is one CFO who is also taking care of the operations in KSA and he's also taking care of the operations here. So in that case, if you see, his salary has to be apportioned between both, like KSA and UAE entity. So what are the metrics, how you are doing this breakup is, again, we just have to establish to the authorities. But yes, if it is related to exempt income, it has to be apportioned on that basis. So any capital expenditure is not allowed. Again, it is a very litigative thing. Capital for A might be a revenue expense to the B. Again, we just have to see like how authority is gonna roll out the further decisions or, clarification on this definitions. So when it comes to an entertainment, here authorities have said that any entertainment provided to a customer or an owner or a shareholder only 50% of it is allowed. So now when we are doing transactions at the source level itself, we have to draw the red flag on this transaction so that it helps us in the tax computation, or it makes the computation easy for the tax officer, whoever is coming to us, like from the internal perspective. So let's get into a exhaustive list of non-deductible expenses. When it comes to non-deductible expenses, yes, on the exempt income, whatever it is related, it is not allowed. If the losses are not connected to the business, is not allowed. Let's take an example like, if you have a sole proprietorship business, he might also have invested in his equity. So that equity would have made profit or loss, but however, they tend to keep everything there in one books of account. So in that case, the loss, whatever he is maintained, is not related to the part of business. So that needs to be ahead. So when it comes to expenditure not incurred for the purpose of the business, yes, again it will be disallowed in the straight case. Any donations to a non-qualifying public entity is also disallowed. Because in this part of the world, like where we tend to give zakat, like, as a part of the thing, but even if it is only to a qualified public entity, yes, it would be allowed. So any bribes or illicit payments is not allowed. In case of fines and penalties, it will be not allowed. Here I would like to draw a little insight. See, there is a small difference between a fine, penalty and a damage for a breach or a breach of contract. So authority, however, says that, I'll be allowing you a damage and a breach of contract, but not fines and penalties. So now one has to look into their contract, it might be vendor-vendee contracts, to see is there any thin demarcation between these. If no, yes, we have to take action immediately and vet our contracts in a proper way in order to, not to encourage the further disputes. Because since it is disallowed, there is a high chance that client will come back and say, it is not satisfying the fine or penalty. How could you do this? How could you charge me in this way? So in order to avoid the further litigations, we just have to vet our contracts one more time and see that, they are in the compliant way. So when it comes to a distribution of profits, yes. See, now that, they have restricted the way of, only dividend is a capital gain that we have seen. But yeah, being a tax professional or being, coming back from India, we have seen like many ways in which we as a chartered accountants were taking through. But yes, here the authority, before the law comes itself, the GAR was there. So currently, like the GAR is running, and if we are trying to do any distribution of profits, even if authority feels the same in another way, that will be added back. A little example is, let's say we are into a retail industry where we are giving a bulk discount to a related party, specifically. So if it is a part of the overall discount within the shop that you have, it's fine. But you are only giving a discount at that discount point of sale, it's only a related party. And again, it is one way of distribution of the profits. It's a revenue leakage that we are trying to do. So when it comes to an interest expenditure, this is a good policy that, the UAE, only 30% of EBITDA has been allowed. So let me draw a little bit on thin capitalization rule. See, basically thin capitalization rule has got two different approaches. Either it might be a debt-based approach or it might be a ratio-based approach. So if it would have been like debt-based approach, the computations would have been very stringent. But we are lucky that, UAE has opted the ratio-based approach. So there are like little advantages and disadvantages in this ratio. The one advantage is it is easy to calculate or compute. One disadvantage is if you look at some industries might actually lose the benefit. So they are not considering the industry or market in which it is. So when someone is doing a feasibility study to enter into a UAE market, this might be a little, triggering thing if he really does it math and it impacts him. So quickly moving ahead, like this is one example where, you just have to maintain the threshold. See, when the payment made to a connected persons or related persons as addressed by the couple, like, it should be at the arm's length. So one school of thought says like, they said only the market value. Where it says like, there might be a benchmark analysis which can be taken as a basis for the computation. But now how far that benchmarking can be used, on what metrics it can be arrived, and how it can be relatable. So one director's contribution cannot be defined as equally. One director might be sleeping or one director might be fully contributing 100% to the entity. So that benchmarking relating would not be on the real time. But however, if you look at the international laws, it also gives where, on the threshold basis. Might be the turnovers of the company would be the basic threshold that would qualify, only some part of profits can be withdrawn in the form of the managerial remuneration or the director fees. So that approach is still a school of thought which can be taken by the authorities if they feel that, benchmarking will make our journey miserable. So when it comes to calculation of the corporate tax, yes, we just have to consider whatever the transfer of loss we can use with 75% ownership. When it comes to withholding tax credit, whatever is the amount that we can adjust within the limit can be used. Any foreign tax credit is there, yes, we can use, but we cannot carry forward it to the next year. Whatever we have, yes, we can use it. Any credits or relief that have to be specified by the authorities, we just have to see it. When it comes to carry forward of the loss, after doing all this computation, we'll be arriving at the, like let's take an example, we have arrived at the loss. It can be carried forward for the indefinite period. But however, when we are carry forwarding and setting off, there are two conditions that we have to take care. At least 50% of the sharehold capital needs to be same. And in that case, if that is not satisfied, at least same or similar line of business is there. So the same or similar line looks as a small thing, but on a real time, if you look, how authority is going to define same or similar line? What if I have a passive income? So will I be eligible to take or not? Yes, operating procedures are yet to be out on this. So thank you, everyone.
Thank you very much, Komal, to give us the idea on this, how to compute the taxable income and the deductibility. Let us have a big round of applause for our speaker, CA Komal. I would like to invite our chairman, vice chairman, and executive committee member, C. Sanjay Gagrani, to the stage to present a memento to Komal. Thank you very much, everyone, to joining us in large numbers for today's event. See you on 25th. So it's a formal vote of thanks. We would like to thank all our speakers who took time and the members to listen, all of them. And of course, the sponsors. Thanks to our principal sponsors, Pan Emirates Home Furnishing, AGMC, Tele, Lulu, and IFCO. Platinum sponsors, Emirates Chartered Accountants Group, WMS, CloudSook, Vested Finance, Nalsoft, UHY James, and Jedox. FMCG partner, Actia. Media partner, Khalis Times. Institutional partners, Delhi Private School. Banking partner, Bank of Baroda. And magazine partner, Finance World. Once again, a big round of applause for all of you, and see you on 25th. Thank you.